Alongside Shauna Smith, this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today, starting with the markets here.
Well, Brad, stock futures are a little changed this morning after the S&P 500 and the Dow closed at record highs Tuesday. It was the S&P 500's 41st record close of the year. All three major averages are on track to post monthly gains. Next big test for the market, that's coming on Friday. We will get PCE, the Fed's preferred inflation gauge.
And semiconductors are in focus today with Micron's fourth quarter earnings out after the bell. The results will be a crucial test for chip makers. The sector has underperformed the broader markets in September. Positive commentary on demand for AI products could breathe new life into the AI trade after hotly anticipated results from NVIDIA last month disappointed some investors.
And Vice President Kamala Harris is set to unveil more details of her economic plan in Pittsburgh today. She's expected to tout manufacturing activity under the Biden-Harris administration and discuss ways to further boost the sector. Her comments will likely stand in stark contrast to former President Trump, who recently described manufacturing trends as, quote, a horror show earlier this week.
Taking a look at stock futures this morning, we've got the Dow, the S&P 500, and the Nasdaq all lower across the board right now. Flat barely to the downside for the Dow and the S&P 500. Nasdaq futures, just 0.1% in the red. Stocks, though, this is the context, have hit fresh records this week as the easing cycle kicks off from the Fed. Investors now have plenty of upcoming data to assess the broader health of the economy and solidify bets on whether or not the Fed will deliver another jumbo cut in November. Take a look at this. Currently, markets slightly favoring another 50 basis point reduction at the FOMC's next meeting. Joining us now, we've got Brian Jacobson, who is the chief economist and strategist at Annex Wealth Management here. Brian, great to have you here with us. Are you in the camp expecting another jumbo cut?
You know, I think that I am warming up to the idea that they might do another jumbo cut. Honestly, I was a little surprised that they did the 50 basis points last time. And so maybe I'm just trying to hedge my bets here because I thought that what they laid out as far as 50 basis points and then 25 and another 25 for the balance of this year kind of made sense. My fear is that we're going to see a little bit more labor market weakness. And if you kind of think about the balance of data that we're going to get between now and when they meet next, we get one more inflation report, and then we get two more job market reports as far as the employment situation report. I think we're going to see a little bit more cooling of the labor market, which might tilt them more towards a 50 basis point cut as opposed to a 25.
So in that event, what are you expecting in terms of the labor data, especially as that's come more into focus and much more pressing for the Fed at this juncture?
Yeah, it's really interesting how a lot of businesses have really tried to shy away from going out and actually laying off individuals, discharging people. And so if you look at the job opening and labor turnover statistics data, the JOLTS report, that shows layoffs and discharges as a percentage of employment are very, very low. Yet the hiring rate is also very low. And so it's almost like they're trying to hang on to the employees they have and just let their workforce naturally kind of shrink through what's called attrition. Now, my fear is that we're going to see that layoff number begin to slowly move higher, not necessarily abruptly. And if that moves higher before the hires rate increases, we could see more weakness. That's likely going to become evident next week, Friday, when we get the employment situation report for the month of September. And then right before the Fed meets, the week before, on November 1st, we get the employment situation report for October. That will probably show further cooling of the labor market.
Brian, are those the two most important reports for the market for investors to be watching at this point?
You know, from a macro perspective, I think that they are. But in terms of what's most important for the markets is October 11th is when we kick off earnings season. And right now, when we go into that, according to some of the FactSet numbers that we've looked at, it says about 4% year-on-year increase in earnings per share, which is a very muted increase. Yet when we look out to what about for 2025, investors seem to be penciling in about a 15% increase in earnings per share, which seems a little aggressive. And so I think that really the biggest data releases are going to be when we get into the thick end of earnings season there.
And so what are your anticipations as we kind of look into what this next earnings season can hold, talking about some of the companies that are expected by the market to continue to show this broadening out, this earnings growth, but at the same time where the macro backdrop that the executives, the CEOs are going to have to discuss, that certainly is more concerning than it was in quarters past.
Yeah, so when I try to correlate what's been going on with the macro data with what's going on with the earnings estimates, the month of July was actually a fairly weak period of time for economic activity as it relates to businesses. And so that's going to be captured in those earnings reports. So really that 4% year-on-year increase in earnings per share, I think that maybe that's a little too aggressive, even though it seems fairly muted. And so we aren't necessarily going to see that broadening of gains on the earnings front. Earlier this year, the earnings gains were really driven by, a few chip companies, technology companies. There's been this expectation that we're going to see that begin to broaden. I think it's still a little too soon to see that. That's why here at Annex on our investment committee, while we were overweight equities when we actually were emerging from that August 5th low, we've actually trimmed that back to be more equal weight. We're not sure that it's actually you're compensated for the extra risk associated with overweighting equities in this type of environment.
So then, Brian, what does that then tell us about this rotation trade that we started to see? If we're not going to see that type of earnings growth that maybe the market is expecting here, maybe won't live up to expectations. What does that mean then for gains from here on out? Will they then likely be muted at this point?
Yes, that's our view, is that actually as we go into the year, it seems like everybody was expecting September seasonalities. It's always a rough month. Well, it's been pretty good. And then everybody thinks that, oh, well, when you come out of an election, that's always, on average, it's been good. Well, the problem is the market never gives you the average returns. It gives you that over time as you go through a number of these cycles. So if everybody's kind of banking on, we get clarity with the election, we know the Fed is cutting rates, and then it's, off to the races come November, maybe we've pre-partied a little bit in terms of the gains here. And so for the balance of the year, we're expecting more choppiness as opposed to a clear direction higher.
Okay, and so as we're continuing to track some of the most recent highs over the course of this week, I mean, a lot of investors trying to figure out, especially if you look at some of the data that suggests that even within the past, the history suggests that if the Fed is cutting within 1% of all-time highs, then we tend to see 14, 15% rallies even from that point. What is the estimation for how much room left there is to run?
Yeah, well, that's where I think that actually we could get that 15% rally, but perhaps from maybe 5% lower. So it's really about when we look out, let's say 6 months and 12 months, we know that the market is on average up a significant amount after the Fed starts cutting. But you have to get there first, right? You have to get through that first 6 months. And it's oftentimes that first 3 months that tends to be the most treacherous. But it's treacherous if you actually just are fearful of if you're not braced for it. So if you view that more as an opportunity to reposition towards more, let's say, small cap, mid cap, more value names, that's where we think the opportunity can really arise. Because even though we don't think we're going to necessarily see a broad rally from here, maybe a little choppiness first, that becomes an opportunity to maybe move a little bit out of what has traditionally been called quality and more towards the value names, a little bit more cyclical.
Brian Jacobson, who's the Annex Wealth Management Chief Economist and Strategist. Brian, always a pleasure to grab some insights with you and some time ahead of the opening bell. Thanks so much.
Thank you.
Micron is set to report its fourth quarter results after the market closed today. The print will provide some key insight into how much AI demand is powering the chipmaker. Joining us now with more and a breakdown of what to expect, we've got Yahoo Finance tech editor, Tech DH, Dan Halley. Dan, what are we expecting here?
Brad, I'd say that AI is powering a lot of this, and it comes down to its memory, high bandwidth memory, HBM. That's something that you're seeing a lot of companies, Micron, Samsung, the like, kind of digging into and really using going forward as revenue sources. So let's just go over real quick what we're expecting versus what they saw last year. So for revenue, they're looking at 7.65 billion is expected. That would be up from billion last year. For EPS, we're looking at $1.11. That's up from a loss of $1.31 last year. And then just to kind of give you an idea of what was going on in Q3, they saw revenue of $6.81 billion. That was up from $3.75 billion in the same period last year. And so basically, they called out HBM as a real catalyst for them going forward. This is going to be something that you'll continue to see a lot of memory makers dive into. They also talked about SSDs, their solid state memory being used in servers. So that's another aspect. But I think for when it comes to memory companies, it really is going to be coming down to this high bandwidth memory and the different types of high bandwidth memory that they're able to offer. NVIDIA doesn't make this stuff; they need it. AMD, I mean, I'd say NVIDIA because they're the market leader, but they don't make this stuff; they need it. Micron's a supplier.
All right, Dan, let's stick with the chip space. You just mentioned NVIDIA, and it's another day, and we've got another headline, so let's talk about it. NVIDIA CEO Jensen Huang has sold more than $700 million worth of the company's stock over the past few months. But when you take a look at the move in the stock here this morning, we are looking at slight gains here. A lot of this is due to reports that maybe he's actually done selling at this point.
Yeah, this is a plan that he had put in place, so it's not exactly out of the ordinary. It's not unexpected. He did it a little more quickly than anticipated. So I think that's where investors are really kind of on the up and up right now, at least for the moment. This company is just outrageous. And for Jensen to still be the single largest shareholder in the company and sell almost $1 billion, $750 million in shares is amazing. And so, now we're just looking for what's going to happen with obviously Blackwell. That's the next generation chip. That's gotten a lot of attention as far as availability. Brad, I heard you mention earlier how investors were disappointed in earnings, which is wild considering it was just that they weren't up 200-something%.
Yeah.
They still beat, but they just, I think I had said it prior to the earnings for the most recent quarter, saying people might be disappointed that they don't see those incredible leaps, and that's what ended up happening.
Right, like expecting somebody to get into the batter's box and hit a home run every single time here. Why didn't you hit a home run last time?
Unless you're Ohtani, then you're just going to do that. Or Judge, by the way, he's crushing it. But
there you
Not
go.
bad. All right, Hallie, great stuff. Thanks so much for breaking down those headlines for us. Coming up, KB home shares are sliding. We're going to speak to an analyst on what might be next for the home builder after its latest earnings report. You're looking at losses of nearly 6%. We'll be right back.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, let's start out with shares of SAP. They're sliding right now as the U.S. Department of Justice is investigating if the German software company engaged in price fixing with U.S. IT services provider Carahsoft and others, according to Bloomberg. Reports say that the Justice Department alleges the companies overcharged government agencies for services over the course of a decade. Shares right now are sliding by about 2.4%. In a statement from SAP that's circulating to media outlets here, they say all that they can say right now is that there's been a civil investigation by the DOJ, and SAP is cooperating with the investigation since the beginning. Company not aware of any criminal investigation as well, they mention as part of this.
Yeah, I think that these are all the details that we have right now, according to this report. And SAP just saying at this information at this stage that they don't have any additional information on this. It's important to point out that Justice Department lawyers have since at least 2022 been looking into potential price fixing. So this is something that's been going on for the last 2 years. They've been doing this on sales to U.S. military and other parts of the government there. This is all according to that report. We're seeing shares under a bit of pressure here this morning. But again, this is what we know now. This is all according to the latest report out from Bloomberg here. And they're citing federal court records filed in Baltimore. So again, this is a story that we will continue to track here at Yahoo Finance. Well, KB home shares are plunging after reporting mixed third quarter earnings, beating on revenue expectations, but net sales staying flat compared to a year ago. They actually missed on earnings. Our next guest feeling maybe slightly more optimistic about the future of the home builder, but let's talk about that. He did at least raise his price target following that latest report. A lot of that, though, I think due to valuation. So we want to bring in Jay McKinless. He is Wedbush Securities Equity Research SVP. Jay, it's great to have you here. So let's talk about this quarter. We are looking at shares sliding here on the heels of this report. Third quarter earnings did miss. What's your first reaction?
Yeah, thanks for having me on. So the leading indicator for the home builders, what we call orders, the orders came in flat on a year-over-year basis. We're expecting plus 10%. I think part of that was pretty big competition on pricing the first 2 months of the quarter. But what they told us on the call last night is that August, which this is an August quarter for them, mortgage rates started to come down. That helped foot traffic and demand. And they said that activity has continued into September. So rocky start, but it sounded like the finish in the quarter was pretty good.
You know, it's really interesting, Jay, as I'm taking a look across some of the reports this morning, both looking back through the report here from KB Homes and then also comparing that to what we're hearing in the existing home market this morning from Redfin, calling it a stale home market at this juncture as some of the houses are sitting idle for more than 60 days. And so all these things considered, buyers right now, they're showing hesitancy, and that is really elevated within this report. Elevated interest rates, economic concerns leading to softened demand in late June through July. But as we continue to expect mortgage rates to trickle lower as the Fed's begun its easing cycle, how might that pass through to KB Homes?
Sure. So I think you summarized where we are in the market very well right now, because it seems like there are pockets of strong demand. There are also pockets of weak demand. We would have thought falling mortgage rates would have had a faster impact or a more positive impact on KB. I think the people who watch these stocks every day, we're kind of looking ahead now to the spring season and trying to figure out whether or not these rates are going to move lower from here. If they are, then maybe a little short-term pain in terms of an order miss and earnings miss might be rewarded as we get towards the spring season. I think the other thing that is going to be applicable for KB and the rest of the group is that buyers are responding to it, and I think that's still the best takeaway we have from KB for the rest of the group is that when rates did start to move lower, low sixes on the 30-year mortgage rate, people did start to show up and affordability got better, but I think for the builders, they have the two benefits of one, being able to offer fresh product versus what you talked about with the Redfin article. But I think also they have the ability to give incentives, do mortgage rate buy downs, do things to help people find the payment they need. that the average existing home seller can't do.
Jay, give us a better sense of what demand is going to look like, because it does look like that there was some volatility here in the quarter. I was going through the earnings call here from executives. I guess, given that volatility, then what is that likely going to do to margins? Because we did see some pressure on margins, or more pressure maybe than expected this last quarter.
Yeah, I think the company's outlook for demand, they're expecting revenues to move all the way up to $7.5 billion for fiscal 25, which that's a November fiscal for them. We were at 7.3 billion. The consensus number was 7 billion on the nose. So it seems like, at least internally, KB believes demand is going to be better than what we were expecting. We did not move up our gross margin target for fiscal 25, mainly just because we do think it's going to be a competitive environment. You might see some mortgage rate volatility on the way to the spring selling season. And so we're just taking a more cautious approach there. But I would say, just in general, gross demand is looking better, at least from KB's front or in KB's internal modeling, than what we or the consensus numbers had put out there.
Within that modeling, I wonder, especially in an environment where some of the higher land and development costs are impacting profitability for KB, where you would look at some of that tapering off. I mean, I follow the wires, and it feels like they're opening up or putting a stake in the ground in new communities seemingly every week.
Yep. Yeah, the land costs continue to go up. I think the good news, and KB talked about this on their call last night, is that they've seen some savings on lumber and some of the other direct inputs, as well as some labor savings. So they're finding ways to offset some of the rising land prices. But you're right. I think that's still the primary challenge for our builders, is not only the cost of the land itself, but the cost to develop it. The environmental surveys and all the other things that go into land development, the cost of those inputs are also going up. So that's another reason that we did keep our gross margin flat for where we were for fiscal 25, just because we're not seeing any slowdown in those land and associated costs.
Jay, great to get some insight from you. Thanks so much for taking the time here with us today. Jay McCandless, who is the Wedbush Securities Equity Research SVP. Thanks so much.
Thank you.
Well, let's switch gears here. Ford and GM shares, they are in the red after Morgan Stanley downgraded both automakers. Morgan Stanley analysts saying China's growing global market share will threaten U.S. car makers, and here in the U.S., rising car inventories, lower affordability, and deteriorating credit also pose as headwinds. There you're seeing shares of both Ford and GM lower. As we were mentioning, GM catching a little bit more of the hit right now. One of the things that was mentioned within this as well is the China market share. And the China capacity butterfly, as was mentioned in this note here, has emerged and is flapping its wings. I mean, we got the full metaphors here. But China producing about 9 million more cars than it buys, upsetting the competitive balance in the West. Jonas, the analyst behind the note, saying here, and even if those units don't end up directly on U.S. shores, fungibility of lost share, profit by key U.S. players adds pressure here at home in the U.S.
He also talked about the fact he was comparing, just historically speaking, some of that performance that we typically see from automakers following a rate cut like we saw from the Fed last week. And he went on to say that U.S. auto stocks typically outperform the 6 months following an interest rate cut and then underperformed during the 6 months thereafter. So, of course, something for investors to keep in mind going forward. Also noting some recent warnings within the German car makers, including Mercedes, BMW, Volkswagen, some of the headlines that we brought to you last week. But Brad, one of the things that you mentioned there just a moment ago was some of the challenges that Jonas highlighted facing the auto sector right now. And what stuck out to me was the affordability issue. We talk about the fact that lower rates, yes, maybe that is going to help boost some demand within the auto sector. But I think the question is to the degree of what? How much is it going to boost demand in the auto sector? Because given he was going through some of these numbers here, the typical car payment right now is up about 40% from pre-pandemic levels. So I think that number right there just still highlights the fact that affordability does remain very, very poor for this sector. Many people are not able to afford cars. I guess one thing that maybe could be good news, maybe for car buyers out there at least, is that dealer inventories are rising, tends to put pressure on new vehicle pricing. But of course, Lower prices, lower margins, that's ultimately not good news here for the automakers, which Jonas is focused on. So a couple of things that jumped out to me in this report.
Yeah, and as we were talking about inventory, as that was a call out within this report as well, it's interesting. There was a J.D. Power report this morning that was published talking about as inventory levels recover, there are certain car companies, manufacturers that might be in a little bit more favorability. And it was interesting to see Ford was mentioned in there, even though they didn't catch, a bullish tenor from Jonas in this particular note. They were saying that Ford remains the top, at least in the pickup truck category, if there was improvement in inventory and then loyalty among customers here. So that being the brand of choice, Ford ranking the highest among truck owners for a third consecutive year. So that was interesting to kind of juxtapose against this particular analyst note as well.
All right, we'll keep right here on Yahoo Finance. Much more coming up. We're counting you down to the opening bell on Wall Street as the S&P 500 closed at another record high yesterday. More on that coming next on the Morning Brief.
Just seconds away from the opening bell there, you're taking a look at the New York Stock Exchange, where they've got an esteemed guest ringing the opening bell, and at the Nasdaq, where you've got Bicara Therapeutics ringing the opening bell. Great big team there, all kicking off today's trading activity. Oh yeah, hit them with the funfetti. Yeah, young one, go ahead, slap that button. All right. We've officially begun today's trading activity here. Take a look at the Dow Jones Industrial Average as we are kicking things off just after the opening cross. We're seeing things fractionally higher. Let's populate this chart for you here. Happy hump day to all who celebrate. We're up right now by about 0.2% on the early inklings of the day here. The Nasdaq Composite trying to figure out its way here. As of right now, though, it is down by about 0.1%. Fret not, still holding on above 18,000 for today. And then the S&P 500, you're also seeing that flat just barely to the upside right now. 5736 is the number where we begin today's trading activity essentially. And then you're going to look at this broader ballpark here. We're remaining within that record high ballpark. We'll continue to see if there are some more in the tape today. Let's get on over to some of the sector activity before I bring in our own Jared Blickery. Here is a look at the 11 S&P 500 sectors here. We've got more green than red, and that's a good thing to start off the day. Let's take a look at consumer discretionary. What's popping off there? Not much. It's down by about 0.2%. But popping off utilities right now, that's up by about 0.5%, leading the pack for the S&P 500 as we take a look at those sectors here. We'll keep close tabs on that and for much more on today's trading activity. Let's get on over to Yahoo Finance's Jared Blickery, who's taking a look at what's moving. Hey, Jared.
Hey, Brad, I wanted to continue the conversation you were having earlier about seasonality because we are now bucking seasonality in September. The Dow just came after, just had its fourth straight day of wins. The S&P 500 has now notched 43 record highs this year. Ryan Dietrich did the math, says it's 22% or 1 in 5, more than 1 in 5 of all days this year. And I did the math and I concur, but this was supposed to be negative. So are we pulling forward some of that rest of the demand that was supposed to come from after the election, some of that bullishness that was supposed to come from after the election? Something to think about. A little too early to tell there. I do want to focus on some of the markets that sprang to life yesterday. Brad just did the sectors, so let me just skip over to what we're seeing in China because that was a huge deal yesterday. I'm writing about it in the morning brief, and we've really seen the authorities there try to juice their economy in any way they can without overstimulating it. And today is the flip side of yesterday. Let me show you the 2-day, and you're going to see these stocks are still holding on to a lot of gains. And most of these stocks are not even listed in China. They're listed in Hong Kong, and then the ADRs trade in the United States. I also want to point out what's going on in the futures market because we had an uptick in silver yesterday. Silver has already been on fire this year. Let me just show you the year to date, and it is just now breaking out of this multi-month base, this nice little cup here, and you put it in perspective of the last 5 years, this has been slow going, but a lot of people are waiting for that chance to take off. That's something we've already seen happen in gold this year. You take a look at GC equals F, that is a ticker for Yahoo Finance, up 78% over the last 5 years. And I read another stat, wish I could attribute it. Going back to 1997, the S&P 500 has actually underperformed gold. Gold is a better asset to hold than stocks since 1997, so think about that as well. Not necessarily a gold bug, but I like pointing out every point of view here. Let me just finish here with some of our leaders and see KWeb. This is Chinese internet stocks. This is over a 2-day period. Let's see what's leading today. Gambling stocks are number one. That's bets. Then we got an IPO. Not seeing a lot of action here. Chinese stocks leading the way down with Korean stocks and Bitcoin. So a little bit of a risk-off day after a bunch of risk-off or a bunch of risk-on days prior.
We'll see whether or not it goes back to being risk-on before the closing bell here. All right, Jared, thanks so much.
Thank you.
Well, U.S. stocks losing some steam after 41 record high closes of the year. But our next guest saying that history suggests that the rally is going to continue post-Fed rate cut. Joining us now, I want to bring in Ryan Dietrich. He was just slated from our very own Jared Blickery. Ryan Dietrich is Carson Group's chief market strategist. Ryan, it's great to talk to you. So you are very optimistic about where stocks are going to head from here. Why are you at all concerned that maybe the 50 basis point cut is a signal that things could be weaker than we thought on the economic front?
Yeah, good morning, everyone, and glad to be back talking about stocks at new highs. You know, I've come on all year saying we're pretty optimistic that this is a bull market. We're still in that camp. Now, the big question, of course, they just did 50. We're of the opinion they probably should have done 25 7 weeks ago. So maybe they just brought the eraser out. And the big argument is the economy slowing? Because, yes, they cut 50 before in 2001 and 2007 and a 100-year pandemic. Not very good times. But we still think, again, what I've said all year with you, inflation is last year's problem, right? So we don't need interest rates over 5% right now. And you look at the economy, I could talk all day about this, keep it fairly simple. Is the labor market slowing? Yes. but look at initial claims, one of the best indicators we have for real time, what's going on with the labor market, hit a 4-month low just last week. Oh, one more thing, earnings. I mean, earnings do matter. Forward earnings on the S&P 500 has hit 267. What in the world does that mean? It was 225 this time at the start of 23. So are things perfect? No. Is the economy slowing down? Yes. Are we going into a recession? No, we don't think so. And we think these rate cuts are going to continue to kind of juice this bull market and honestly help this economy going forward.
To what extent? I mean, what type of percentage have we seen in the past to suggest that we could see even more upside from here? As I'm looking at some of the stats that Jared brought up and that you were posting about as well this week, 41 all-time highs for the S&P 500 in 2024.
Yeah, 41's an awfully lot. Extrapolates out to up over 50, which would be one of the most ever. But, we took a look at kind of, can the Fed cut interest rates near all-time highs? Because people are wondering that. Yes is the answer. I went back to 1980, found 20 times they cut interest rates within 2% of an all-time high. 1 year later, higher, 20 times, Brad. And the average return about 13.9%. So let's just round it to 14. Are we going to have two back-to-back 20% years? It's looking like it, right? Will we have 3? Probably not. But at the same time, double-digit returns this time into next year if the economy hangs in there. We think it's possible. Now, one more comment on this. That's large caps, right? I've come on with you all year, say we like small caps, we like mid caps. Mid caps been our largest overweight all year. And historically, when do those really start to outperform? It's once the Fed actually starts cutting, right? We saw that big rally last year, or late last year. We thought the Fed would cut sooner. Then we had the jump in inflation and in the economic data the first quarter this year, which pushed things back. But now that the Fed's actually cutting, we think small and mid caps will probably outperform large caps over the next year.
Ryan, what does that upside look like, do you think?
Well, like I said, upside with the S&P 500 this time from right now to, let's say, come back in 12 months, right? A year from now. We wouldn't be surprised at all. We had 12 to 15% returns on the S&P 500, but small caps and mid caps, honestly, could probably be more than 20% or so. Low 20% or so is what we think is possible. And that's the thing about this market, right? I mean, everybody's like, large caps here and small caps there. Everybody's arguing about everything. I mean, sometimes a diversified portfolio, sticking with kind of, rebalancing every 3-6 months or so, that's the best thing for a lot of investors out there listening. I mean, don't always chase a shiny object. We've been neutral. Last comment. We've been neutral technology most of this year. A couple, 3-4 months ago, people thought we were crazy to say that. There are some really stretched valuations in technology. Doesn't mean we don't like it. Again, we're neutral, but there's some other areas like financials, like industrial, small caps, mid caps that are pretty cheap historically, and those areas we're overweight.
Ryan, are you just looking past the election and any uncertainty that could cause, given the fact that you are so optimistic about the returns that we could see over the next 12 months?
Can't we just look past the election? Is that okay? Yes. Well, let me put it this way. The second half of September, like Jared just talked about a little bit, is usually when the volatility happens. Well, not so far this year, but it is October coming up, the worst month in an election year, the most volatile month historically. We're thinking it makes sense. We're going to have probably that October election surprise, whatever it might be, some October volatility. Just remember, though, once you get through the election, markets can take bad news, markets can take good news. They just don't like uncertainty. We're going to have a lot of that. And the good news for investors out there, November historically is very strong in an election year, and December is too. So if we get some rockiness in October, that's okay. One more thing on this. I mean, S&P is up 9 of the last 10 months. All right. The only month we've been down is April, which usually is a pretty good month. So go figure there. So we might be up 10 out of 11 months here if we're higher in September. So this has been a great move. Markets don't always go up. Maybe we're due for that October volatility. But again, bigger picture, we would be actively buying any weakness for into your rally and even into next year.
Ryan Dietrich of Carson Group. Ryan, always a pleasure to catch some time with you. I mean, I enjoy tracking your posts, but it's better IRL, or at least over the interwebs or the metaverse, or, just this simulcast.
Thank you.
Thank you. Guys, coming up, Google takes a swing at Microsoft after filing an antitrust complaint with the EU. We'll tell you what's at stake on the other side of this break. Vice President Harris is set to unveil her manufacturing policy later today in Pittsburgh, Pennsylvania, a city known for its steel industry and critical swing state ahead of the presidential election in Pennsylvania. For more on what we can expect is our very own Washington correspondent, Ben Werschel. Ben, what ultimately should we be listening for here from this appearance?
Yeah, so what we've got is a broad speech coming, and this is according to a senior Harris aide, on the economy. It's her kind of major speech on the economy that they're offering this week. The new details in here are manufacturing. So that's what Harris is focused on, and that's what we're going to see. I think people can think of it as akin to a CHIPS Act 2.0, but for other industries. How she plans to stimulate other sectors, other manufacturers remains to be seen. Is it tax credits? Is it stimulus? But areas like biotechnology, shipbuilding are getting a lot of chatter focus. So that's kind of the third plank of what she's calling her opportunity economy. And the manufacturing part is a strength for her in terms of touting Biden's record. There's a lot of what we've seen is a lot of factory construction in the last few years under infrastructure, the CHIPS Act that I mentioned, and also green energy credits, that we have seen a lot of manufacturing growth. So she's going to have to tout that, but also talk about sort of where she's going forward. And then she's going to weave in the other aspects of her agenda, lowering the cost of living, the care economy, stimulating small businesses and things like that into kind of an overall speech.
Ben, compare what we're likely to hear from Harris today to what we've heard from Trump, because we were talking about earlier in the show that he's been saying that, I think he actually called it, quote unquote, a horror show when he was talking about the manufacturing sector under the Biden-Harris administration and what he's seen there. So how does what we're likely going to hear today from Harris, how does that compare? And it's very, very different, starkly different than what we've been hearing and will likely continue to hear from Trump.
Yeah, for sure. It's kind of manufacturing week here on the 2024 campaign. So Trump was in Savannah, Georgia yesterday for his own economic address focused on manufacturing as well as stock code. And as you mentioned, he called it a horror show. He definitely didn't tout this factory construction we've seen. His focus is on specific companies. He's talked about John Deere and tariffing them if they try to move out, and other companies like that. So his plan is kind of the same ends, but in a very different way. It's tariffs. It's not breaking news to anyone that Trump loves tariffs, so he's doubling down on that. But he's also talking about things like lowering the corporate tax rate and other ways, kind of carrots to bring companies in. His promises that he'll bring manufacturing forward and bring companies in. Both Harris and Trump are set to promise that, and then, as I mentioned, sort of do it in very opposite ways.
All right, Ben, always great to have you. Ben Werschel, thanks so much for hopping on with us.
Thanks, guys.
Google taking a swing against one of its biggest cloud competitors, a company filing a complaint with the European Commission against Microsoft this morning, accusing the software giant of using anti-competitive practices to lure customers into its cloud platform, Azure. Here to discuss what's at stake is Adam Kovakovich. He is the Chamber of Progress founder and CEO. Adam, it's great to have you. So talk to me about this case. When you take a look at it, clearly you have this head-to-head going on between Google and Microsoft, not necessarily anything different than what we have seen in the past. But what do you think of this case specifically? Could it get some traction?
Well, I think we have to see. We think of Google primarily around search, but it is competing in cloud computing. But it's in the third place position behind Amazon and Microsoft. And so what they're doing in this case is a little bit of a turnabout. They're saying that Microsoft has had terms in its contracts, its cloud computing contracts in Europe, that lock in customers, that make it hard for competitors to get traction. And you have to remember, European competition law is much more complainant-friendly than American law. So this could get traction. It's also not a new issue. Microsoft had settled a similar complaint a few months ago in Europe, and several regulators across Europe have looked into this issue. They've identified some issues with Microsoft bundling their cloud and their enterprise software and raising concerns about some of their restrictive licensing practices.
And so with that in mind, I mean, what is the likely outcome from this in terms of some of the damages that could be brought forth?
Well, the EU process tends to move kind of slowly, and so this is probably a multi-year item to keep your eyes on. I would also say, too, the European antitrust enforcers tend to focus on helping small challengers against big tech. rather than helping big tech companies against each other. But on the other hand, I mean, one of the things that's interesting about this is that if you say you want more competition, then having 3 strong players is probably more realistic than, propping up some small European cloud provider from nowhere to compete. So it sort of tests what European antitrust enforcers really care about. Do they really want to foster competition, or are they just about helping, European companies?
Adam, is this reminiscent of what we've seen in the past when the two have gone head to head? And I guess what have we learned from some of those settlements, maybe, and what that tells us about what we could see as a remedy here?
Absolutely. I mean, this is a Cold War that's gone hot between Google and Microsoft for years. Microsoft has been an antitrust antagonist against Google here in the U.S. They were probably the main instigator of the U.S. Justice Department's antitrust suit over Google that just had a verdict around its search distribution contracts. And the guilty verdict against Google probably stands to benefit Microsoft's Bing most of anyone. So I think one of the things you see here is Google punching back and saying, look, Microsoft's contracts lock in cloud customers in the same way. And there are even some echoes of Microsoft's late 90s antitrust case, because that also had to do with Microsoft's contractual terms preventing customers from using alternatives. Google is making the same allegations here.
Adam, as we're thinking about where this could net out in terms of how these companies have to define the partnerships that they're also kind of working towards, I mean, could there be a strategic shift that we see these companies have to enact in their cross-border relationships even?
Well, again, I think it's difficult. I mean, again, the cloud computing is frankly an area that antitrust enforcers probably haven't paid that much attention to. It's a little hard for them to see, to wrap their arms around, but it's really important. It's a big business. It's a growing business. Microsoft's actually the number 2 in that space, behind AWS. But I think, but it has a real impact. And part of Google's argument is that European customers have actually been bearing the financial brunt of not being able to transfer their services between different cloud, their data between different cloud providers in Europe. And so, this is going to be an interesting test about whether antitrust enforcers feel inclined to roll up their sleeves and care and take a closer look at the cloud computing market, which they haven't done to date.
Adam, another story that we've been closely watching is Intel's potential takeover. A report earlier this week revealed Qualcomm is exploring a takeover in Intel, looking into the antitrust side of things. What is the likelihood that this deal could even happen, and could this ever go through?
Yeah, well, look, I mean, I think this will be a fascinating test because on the one hand, the Biden administration has carved out a very clear industrial policy saying we want to be, supporting U.S. semiconductor manufacturing. That's something Intel's obviously in very tough straits right now, and this deal could really provide an important lifeline. Basically, also make it easier for help the U.S. compete against foreign competitors. On the other hand, it would be a big price tag deal. And the DOJ and the FTC have taken, have really raked those deals over the coals and blocked several of those deals. So I think in some ways it's a little bit of a test of the competing mindsets of the Biden administration, of course, which is coming to an end. Maybe this becomes a question for a Harris or a Trump administration, but it puts those two competing values to war with each other. Do we care about, just the size of the deal, or do we care about beating other companies, other countries' companies?
Adam, the conversations that you've been having, I'm just so curious, how are executives thinking about the M&A landscape, given the election, given the uncertainty, and given the fact that if Harris were to be in the White House, the environment here for some of these larger deals, it might not change just in terms of their favor too much?
Well, as you talked about earlier, Vice President Harris is giving a big economic speech in Pittsburgh today, and I have been very encouraged by the tone that she's taken about business, which is that, as a politician, she has not prioritized going after business. And actually, some of the comments she's been making on the trail, and I think we'll make today, talk about business as a partner. And so, I don't see her prioritizing kind of hostility towards business. I think there's also a good argument that, M&A activity is good for the virtuous cycle of investment in startups, that, when one company gets acquired, it creates capital that then helps the next startup get started. And that we've seen, challenges in the startup market because of that. I actually think she's going to be very sympathetic to that because she wants to see new companies arise, and to the extent the M&A policy of the Biden administration has actually hurt startup growth, I suspect that's something she's gonna, really hear and listen to and probably take action on. I don't see her being wedded to also the personnel that Biden has had in these positions either.
That's interesting. Adam Kovacevic, who is the Chamber of Progress founder and CEO. Adam, thanks so much for taking the time here.
Thank you.
Certainly. Coming up, some top trending tickers from Yahoo Finance's homepage. Stay tuned. You're watching The Morning Brief. Taking a closer look here at Yahoo Finance's trending tickers. 3 names to watch. We've got Tesla, DoorDash, and Stitch Fix. We're doing it in 30 seconds or less each, or at least we're going to try. First up, Tesla. Piper Sandler raised its price target to $310 from $300 for the EV maker on increasing third quarter and full year delivery vehicle estimates here. As we're taking a look at shares, as of right now, they're flat, just barely to the downside here. So reversing some of what we had seen earlier in today's trading activity and just around the flat line as of this point. We're expecting those results to come, the unveiling as well, a larger unveiling in October 10th in Los Angeles. And that's going to be a key point as well for Elon Musk and Tesla going forward.
All right, we are also watching shares of DoorDash this morning. KeyBank Capital Markets raising the stock to overweight from sector weight. They're citing ongoing gains in food delivery and grocery delivery. Raymond James also resuming ratings on DoorDash with an outperform, citing the potential for upside. When you take a look at shares today, up just about 2%, actually hitting a new 52-week high. Had risen above 145 briefly. But going back to these calls, analysts very positive on some of the headway for DoorDash here going forward. KeyBank at least making the point here that it has grown more comfortable about the company's consumer with his survey showing ongoing gains in food delivery usage. So again, price target set at 177, about 25% higher than here.
All right, let's finally hear talk Stitch Fix. Ticker symbol SFIX, down about 34%, plunging after the personal styling company reported a wider than expected fourth quarter loss and issued some disappointing guidance here. I'm just going to rattle off two figures here. Active clients, that was a decline of 20% year over year. And then additionally, net revenue down 16% year over year. Oh yeah, here's a bonus one for you as you're taking a look at some of the revenues per active client. Even though that was up 5% year over year, 2% quarter over quarter, there's still larger questions about how this company continues to operate in a larger environment, or not just operate, but appease the customer in a larger environment of customization and personalization.
All right, well, coming up, the latest reading on the housing market, new home sales out at the top of the hour. We've got that for you, and maybe ultimately what that could indicate about inflationary pressures next. That's coming up on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. We've got three market catalysts today. New home sales out right now, China's big stimulus push, and the economic fallout from geopolitical conflict.
And stocks muted after actually looking like they have turned around to the upside with the S&P and the Nasdaq in the green here. This comes after the S&P notched its 41st record close of 2024. Traders pricing in 75 basis points of rate cuts through year end. Every single piece of economic data being being picked apart by traders. In the latest, we've got those new home sales numbers. We'll tell you what they tell us about the Fed's path forward.
Plus, China continuing its stimulus push with the biggest ever cut to its one-year policy rates. What could this record easing in the world's second largest economy mean for global markets?
And world leaders gathering at the UN amid mounting geopolitical conflicts. A new report from the World Economic Forum showing how political volatility could impact global economic policy. We'll discuss more with the managing director at the World Economic Forum.
All right, first we want to get to the breaking news that we have out on the housing market right now. New home sales falling less than expected, actually coming in higher than expected, 716,000, a 4.7% decline from the revised rate of July, but it is 9.8% above the level that we saw a year ago in August of 2023. Taking a look at the median sales price of new homes sold in August of 2024, that was just over $420,000. The average sale price was $492,700. So again, we are seeing a 4.7% below the revised July number, but coming in slightly hotter than expected here, Maddie.
Yeah, it's interesting that they fell less than economists had expected in the month of August, exactly like you said, Shauna, and that we had new home sales falling 4.7% month over month. The estimate there was 5.3%. So that number coming in a little bit underneath what the estimate was in terms of new home sales month over month here. Having said that, I think it's really interesting to see the market reaction to every single piece of economic data. Usually we don't see a ton of action off of a print like this, but I think moving forward, we are going to see a lot of concentration on every single data point that we do get in, even if it's something that historically has not necessarily moved markets, as the market does look for a lot of clarity about the Fed's path forward after that larger than expected rate cut. It's certainly going to be a time for a lot of digesting, picking apart what's underneath the hood of each data point, including one like this. But I want to move on to the market rally that we are seeing today, coming after the S&P and the Dow both closed at record highs on the back of that big stimulus push from China, and also dovish commentary from Fed officials. You can see here the S&P up about 0.1%, the Nasdaq up 0.3%. But let's talk about the next catalyst that could drive market gains. Sean, I thought it was interesting that we saw companies with exposure to China obviously have been under pressure. We saw those individual names getting a lift yesterday, but it wasn't necessarily enough to, lead to gains across the broader market, right? It was really Nvidia and some of those big tech names returning to be the drivers of that rally yesterday. Analysts saying it's too early to know how much the China news is going to continue to be a positive catalyst for the market. We had a China Beige Book official saying that this stimulus from the Chinese government could be a real sea change, but JP Morgan then saying not so fast on that. So I think the next big focus, of course, is going to be the labor market data. That's what the Fed has been telling us. We've got those initial jobless claims coming in tomorrow and 2 Fridays to go before that NFP print that is going to be a critical one for the market. And also, real quick, want to mention consumer sentiment. Share of people saying jobs were harder to get, its highest level since 2021. So I thought that was interesting to watch.
That is interesting. We've talked to a number of strategists and some economists here over the last several days, and many of them saying that the 2 next prints that we get on jobs, the monthly jobless prints here that we're going to get before the next meeting, that is really going to be critical here in terms of what we would likely hear from the Fed or what the Fed's decision is going to be at that next meeting. Obviously, the print that's coming up here for the most recent month, the month of September, that is going to be critical here for the Fed. Also, I'm going to be closely watching PCE on Friday, and we talk about this because Michelle Bowman, the lone dissenter within from the last Fed meeting, has talked a lot about the fact that she doesn't think some of those inflationary pressures are done, and she is still worried about the fact that inflation is still up significantly when you compare it on a year-over-year basis, going back to the start of the pandemic. And we are expected to see improvement on Friday when those numbers are released. We are expected to see a month-over-month improvement and year-over-year improvement. We're expecting a month-over-month rise of just about 0.1%. The previous was a 0.2% rise. So if it does come in below expectations or even at expectations, that would be welcome news from the market. And also just a further indication that the Fed's battle here to tame inflation does seem to be, if at least not now, getting closer and closer to being in the rearview mirror.
Yeah. Absolutely.
All right, well, the PBOC's latest efforts to shore up China's economy not giving the global boost it did to stocks after its initial policy announcements. For more on the outlook for equities, let's bring in Steve Sosnick. He's Interactive Brokers' chief market strategist. Steve, it's great to see you. So we did get a little bit of, excitement, optimism into the markets yesterday on the heels of the news that we got out of China. Of course, that's coupled with the Fed decision last week. I'm curious what you make of the market at these levels.
Hey, Shauna, great to see you. I think in general, investors should be rooting for the Chinese to succeed at this. There's certainly concerns that the Chinese economy has been under a lot of pressure, much more than they might be letting on, because there's always been rumors that their numbers are a bit massaged, and that the fact that they're willing to undertake sequential large measures to stimulate the economy is a sign that certainly at least the powers in charge in Beijing are a bit nervous. But this is something, I know there's a lot of back and forth rhetoric about China, et cetera. As U.S. investors, we should be rooting for the Chinese to succeed, because the problem is if they don't, that's not good for the global economy overall. I think we have to remember how in the aftermath of the global financial crisis, one of the things that helped us dramatically was that the Chinese economy was expanding so rapidly, and as a result, it had spillover effects into the rest of the world. The flip side is, if their economy shrinks dramatically, that will also have spillover effects into the rest of the world, just as it seems that things are slowing down, not necessarily getting bad here, but definitely off their rapid pace. So this should be good news, although I think the idea that, I've had some people say that, they brought out a bazooka when they needed a howitzer. So that there's a lot of conflicting views as to whether this is actually sufficient given the levels of issues in China.
Yeah, and then you had China Beige Book officials saying earlier today that they did think that it was sufficient moving forward. So a lot of conflicting reports, Steve. Having said that, I am curious if the stimulus news coming out of China was enough to make the market excited for what felt like 30 seconds to me. What is going to be the next big catalyst for the market? Is it going to be the labor data that we're getting in later this week, or is it something else?
Well, I think you both hit it in the intro. I think the PCE is the first one. Remember the dual mandate. And Powell went out of his way to remind us of the dual mandate. It's stable prices, it's maximum employment. Well, we learn if prices are becoming stable on Friday with the PCE. So that will be number one. That is the Fed's preferred inflation measure. Looking at the month-over-month core, which is probably the most relevant, if the predictions come in at 0.2, that's at least consistent enough with the disinflationary story and the 2% target. So any deviation from that can move the market one way or the other. And then, of course, the following Friday, we have jobs numbers, which those will certainly have an impact on the market one way or the other, because, we've really sort of shifted in some ways almost to declaring victory over the prices, whether or not that's fair or not. But certainly now everybody's focused on employment, and this is how we find out what's going on in the labor market.
So, Steve, what should investors be doing? We talk about the fact that defensive plays have certainly caught a bid here. We talk about the fact that maybe technology won't be the leaders here. If we do see this next leg higher, what are you advising, or I guess where do you see the most opportunity today?
Well, right now things I think are very fully valued, Shauna. That could be one of the issues here, and that does make it a bit tough, because there's not a lot of great values to be found, whether or not in the growth stocks that have taken us to the party or the value stocks that have caught a bid recently. I think in general, value stocks are preferable. I think in general, one of the things that you will not go too wrong with is finding stocks with sustainable dividends. Those tend to be value stocks as opposed to growth stocks, although a lot of the growth stocks are now paying dividends. But I think right now the key is if you're looking at a potentially lower interest rate environment, it's not a bad idea to lock in decent yields in stocks that can, as long as those stocks have the cash flow to support those dividends and are not borrowing heavily to pay them off, because that adds a level of risk. So that's where I would be looking. I can't get too granular just because that's the nature of my job. But I would look toward value-oriented stocks with a solid dividend, and I think that will help you both get capital appreciation and income in a time where income might become more scarce.
Steve, great insight as always. Steve Sosnick, thanks so much for joining us here this morning. Interactive Brokers Chief Markets Economist. Thank you.
Thanks.
Coming up, a new report from the World Economic Forum showing that global growth could take a hit from high debt levels and political uncertainty. We've got more on those findings and what they could mean for your portfolio next. And a programming note, join us as markets editor Jared Blickery sits down with A-list strategists to decode the day's market moves. From the word of the day to who wore it better, this is Yahoo Finance in its best form. Stocks in Translation airs every Tuesday and Thursday at 8:30 a.m. Eastern Time. You won't want to miss that. We'll be right back. New report out from the World Economic Forum is showing that while there is optimism over easing pricing pressures and strong global commerce, long-term growth and stability facing significant risks from elevated debt levels and political polarization. Joining us now to discuss those findings, we want to bring in Sadia Zahidi, Managing Director of the World Economic Forum. And Sadia, it's great to have you here on Yahoo Finance with us. So talk to us about what you found in this survey. You took a survey of leading chief economists. It looks like there were some reasons to be optimistic, but like we just said, the warnings on debt and political polarization seem to be challenges here that could constrain some of that future growth.
Yeah, thank you for having me. What we find essentially is that a large set of the chief economists, larger than before, are tentatively pointing towards the long-awaited soft landing. They're basically saying about 54% are saying things will look relatively stable, we'll have this kind of tepid growth that we've been having. And 37% are saying it could get a little bit worse. And then there's 9% that think that things could be getting better. So overall, the majority are finding a positive outlook. Now, things are very optimistic in the United States. Over 8 out of 10 of the chief economists that we surveyed are expecting either strong or moderate growth. When it comes to Europe, it's almost the reverse. Most are expecting very weak growth. And when in China, it's about 6 out of 10 are expecting moderate growth, 4 out of 10 are expecting much weaker growth. So across those 3 core economic areas, a mixed picture, but definitely a positive outlook for the US. And then, of course, you mentioned, elections and the geopolitical outlook. So 8 out of 10 chief economists, regardless of where they are based in the world and which sector they are in, are of course expecting the outcomes of the US elections to have a massive impact on all of these predictions. And then, of course, we're going to see what things look like in January with the next quarterly outlook.
That was going to be my exact next question, Sadia, about the potential impact of the oncoming election, and that could certainly impact the debt levels in the United States. And you talk about the global concerns about rising debt. What stood out to you just in terms of the impact of rising debt? Can you kind of operationalize that for folks? Why is that such a worry?
Yeah, so there's definitely more concern about emerging markets and developing economies than there is about advanced regions like the United States or like Europe. There's definitely still a lot more optimism, even with relatively high inflated debt levels. There's much more concern when it comes to developing economies, and then the risk of contagion that may create across other emerging markets as well. There's about 3.3 billion people that live in economies where the debt servicing levels are actually higher than what those economies are spending on, for example, on health and in education. Now, that's particularly a developing economy problem. And what that then means is that some of that social spending, there's a lot of trade-offs compared to servicing some of that debt. So overall, there is a fiscal squeeze. And I think overall there's also a pattern. When it comes to election years, spending by governments tends to be higher, and then post-elections there tends to be a reckoning where then some of that spending needs to be brought under control. But the economic nationalism mood in most advanced and emerging markets will make that very difficult for governments after this bumper election year in 2024.
And Sadia, as we try to figure out, I guess, ultimately what this means just in terms of the likely catalyst here for the global economy going forward, a lot of that has to do with maybe how some of these issues are addressed. So what can you give us any insight into, I guess, the ways to best address some of these issues and maybe what that resolution then looks like?
Yeah, so we've had a really interesting picture from the chief economist this year. One would think that the traditional wisdom is that most chief economists across most sectors and regions would tell you, focus on growth, focus on top line growth, and everything else is secondary. We're actually hearing something very different. 2/3 of them are saying, yes, focus on growth, but 2/3 are also saying that it's important to look at other targets like sustainability, like equity, like national security. And so you essentially have a set of top economists in the world that are saying, yes, growth matters, but the quality of that growth also matters. And if we address some of those fundamentals, if we invest more in basic, public infrastructure, if we invest more in education or in healthcare, or if we invest more in some greener technologies, that is going to be, in the long term, better for coming out of this sort of tepid growth trap that we're currently in.
All right, Sadia Zahidi, Managing Director at the World Economic Forum. We got to leave it there. Thank you so much, though, for joining us.
Thank you.
Coming up, we are talking all things chips, from valuations to the future of Intel, amid reports of a potential takeover, and the outlook for energy efficiency as the industry bets big on AI. All of that and more is right here on Catalysts. It's time for some of today's trending tickers. You can scan that QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. All right, we got quite a few chip makers on the move today ahead of Micron's fourth quarter earnings print due after the close. For a look at the semiconductor space, we're throwing it over to Yahoo Finance's tech editor, Dan Howley. Hey, Dan.
Yeah, Maddie, let's compare some of the biggest chip names on the street with the help of Yahoo Finance's Compare Stocks feature. That's synergy. That's what I'm talking about. When it comes to market cap, nothing even comes close to NVIDIA. The chip maker's current value hovers just above $3 trillion, and it topped that mark back in June. Then AMD, not so close behind, with a $259 billion market cap. Qualcomm follows with $186 billion. And then there's Intel, which is hovering just about $101 billion. It's been a very different year for these stocks as Intel has struggled to keep pace with its competitors and has sank its stock price more than 50% since the beginning of the year. So what's driving this? Competitors competitors in the near term. For Intel, it's about the problems it's facing and its efforts to turn things around, not quite convincing investors. It has some work in AI, it has some work in PC, but because it just didn't have AI set up like NVIDIA did, it's not doing that quite well. AMD, meanwhile, is taking shares from Intel and looking to benefit from the AI explosion as an alternative to NVIDIA. Qualcomm is all about its smartphone business, and now it's trying to expand into the PC space with its own PC chips, as well as looking to potentially take over Intel, but that's far from guaranteed. And NVIDIA, well, it's the market leader and will be for the foreseeable future.
All right, Hallie, great stuff. Thanks so much for breaking that down for us. We want to stick with the chip sector, specifically zero in on Intel, because here we have one of the most dominant semiconductor manufacturers on the street. Intel stock has collapsed over the past few months after a string of bad earnings. And now reports are swirling that Qualcomm is eyeing the beaten down chip sector or chip maker for a potential acquisition. Joining us now, we want to bring in Eric Jackson. He's EMJ Capital founder and president, and Yahoo Finance executive editor Brian Sazi joining us now on set. The two of you are the perfect people to talk to about this. So Brian, let me go to you first, because when you take a look at Intel's problems, it goes back a lot longer than over the last few months. And you talk about the fact that they're at this massive disadvantage. I'm curious what your thoughts are on the likelihood or maybe the fact or what the future of Intel even looks like.
Well, I think the real hero here is Dan Howley. I mean, you see that valuation comparison that guy just did. I mean, that was some awesome stuff. But look, we've gotten to really see Pat Gelsinger over the past 3.5 years. He was one of the first people. He came up with us first out of the gate when he became the CEO of the company. And he's just been trying to move this very big ship that is Intel while still having to deliver for investors. So he's taking a lot of swings and he's had a bunch of misses too as well. But I talked to Pat after this company's most recent quarter. It was a tough quarter, tough outlook, another quarter that I think surprised the street. After a couple quarters that were suggesting the turnaround was happening, here's what Pat told us.
We're going to build a sustainable Intel in products and technology, and a sustainable Intel in our financial performance as well. That's what the market expects of us. You know, we have to have a company that's good for the long term. That's what we're creating. That's what we've signed up for. That's what I've signed up for, and I'm committed to finish the job that we started.
And a really key point there by Pat, what the market is questioning, can Intel and Pat build a sustainable company? You're looking at reportedly Apollo looking to invest in Intel, of course, Apollo, parent company of Yahoo Finance. Did Qualcomm really approach Intel? My sources suggest that may not actually have been the case. But you have to keep in mind, too, why Pat is getting this leeway as he enters year 4 is because a lot of people do, in fact, love Pat, and they are rooting for him to turn the company around. He's been at the company before this latest leadership stint for almost 30 years, driving a lot of key innovations, and he is a different leader. I went back and the team went back and checked out an interview we did with him in 2021, right out of the gate, and you really got that sense this guy ticks a different way, and I think it explains why people are in fact rooting with him and giving him a lot of leeway to try and fix the company.
I'll say every neural pattern that I've ever exercised is being used fully every day on the job at Intel. It's exhilarating. You know, it's a great honor. And to join with the 110,000 other talented souls that are part of this great, iconic firm, it really is, an extraordinary opportunity that I've been given to come back and play this role.
And if I have this right, Maddie and Shauna, Pat was the first chief scientist inside of Intel, studied under legendary CEO Andy Grove. So he's got a lot. He's got a strong resume, and if anybody's going to pull this turnaround around, it is going to be him. But it's challenging times right now, and as Dan Halley pointed out, you can see that in the stock price, the market cap, and the news flow.
All right, Sazi, that was a great overview of the situation. I think it was a great soundbite you got out of him, too, about utilizing every neural pathway that he has for this role. Eric, I want to get your take on this. Let's say that the neural pathways were a little bit under pressure over the past couple of months, and, Gelsinger called you for advice about the path forward for the company. What would you tell him is the single biggest thing that Intel could be doing to really turn things around for shareholders?
That's a tough one. Obviously, when you see those two clips back to back, it's obvious Pat tried to give himself a wide berth, that this wasn't going to be a quick turnaround. And he had a lot of respect, as Brian was saying, internally at the company for his tenure with the company and his scientific background. But clearly, he didn't move fast enough, and he didn't cut deep enough. And there just wasn't as much of a sense of urgency as there needed to be. So I would, they're trying to make amends for that now. It's a little after the fact. So the one single piece of advice I would say would be to, step on the gas and keep going. But I don't see a quick fix here. I don't see a lever to pull, whether it's taking money from Apollo, separating the company into two businesses, as has been speculated about. All of these roads I see leading to basically a 10-year slog in trying to turn this company around, to fix the cultural issues. And unfortunately, that's just, I don't see any faster way for Intel. The biggest thing that they have going for them is that the United States and the Western world needs this Intel and their foundry business to succeed. It has to succeed, whether it's independently or it's part of Qualcomm or somebody else. But there has to be a protection against the possibility that TSMC, gets sort of taken out if China was to invade Taiwan.
Eric, given that and given the fact that at least of what you see as the strongest point or maybe the most optimistic point of their business right now, are you skeptical at all just about the merits of any of this interest surrounding this transaction? I guess, how much should we really be putting into the fact that how likely any of these scenarios are?
Yeah, I think from a regulatory point of view, I think that kind of a deal, Qualcomm taking out Intel, would pass muster, because it's all about America, an American, having basically a stake in this game going forward. So I think regulators would approve it, but would Qualcomm investors be jazzed about it? Would Intel investors be jazzed about it? I mean, it has to work for both sides. I don't think Qualcomm would be willing to pay up, even though this Intel is trading basically close to book value. And from an Intel's perspective, why just be subsumed into this larger company at this 30-year low price in the stock? That's not really attractive for anybody who's unfortunately stuck it out through these last few years. So it's hard to see how there could be a deal here to be had that works for both sides.
Really important point I think Eric brought up here, Maddie and Sean, is that he sees a potential for a 10-year slog for Intel. Yeah. And what's hard for me sitting here is it's unclear what Intel would look like 10 years from now. Can you confidently say they are a leader in AI chips? Where is NVIDIA 10 years from now? Where is AMD from now? You would have to imagine even stronger given how strong they are. So I mean, that's tough. I mean, the outlook is tough.
Yeah, and where are the investors going to be 10 years from now? We know that, Eric, you've already sold off your Intel holdings, so certainly something that is going to be tough for shareholders, I think.
Word of the day, tough.
Certainly tough for Pat as well. All right, Eric Jackson, EMJ Capital founder and president, thank you so much for joining us. And Sazi, thank you for joining us here on set as well. Let's continue the conversation around the chip sector. One of the biggest concerns big AI players like NVIDIA have to contend with is increased energy use. I had a chance to sit down with Dion Harris. He's NVIDIA's head of data center product marketing, as well as our very own Inez Ferre joining me for the conversation. We discussed energy demand for data centers and how the new Blackwell chip could lead to more energy efficiency for customers. Take a listen.
Blackwell was purpose-built from the ground up to really make sure it could deliver the most performance and efficiency. And so when I say from the ground up, of course we started with an incredible processor, and that's the Blackwell processor. We also coupled that with our Grace CPU, and that's actually 2 times more energy efficient than the standard x86 CPU. And then, of course, we also looked at how do they communicate to each other. So we have a proprietary communication protocol called NVLink, which allows GPUs to connect to each other at very high speeds, and that eliminates a lot of the bottlenecks and therefore drives more efficiency. So when you look at the full system, 72 Grace Blackwell chips, processors connected over this NVLink fabric, it provides incredible performance that's actually 25 times more energy efficient than our previous gen, which is a Hopper-based system. So when you think about where the state of the art is today, most of the models are trained on Hopper and sort of our cutting edge platform that's available today. Blackwell is going to truly advance the state of the art in terms of performance and efficiency by over 25x.
So you have that efficiency when it comes to technology, but talk to us about the demand for electricity side, for energy. I mean, these are more efficient. However, because they're more efficient, you're going to be using it so much more. So you still will need a lot more energy to run.
So there's kind of 2 different views of that. So when you think about the discussion of energy, it really becomes a short term versus long term. In the short term, most of our customers, you can't just go and build out a data center tomorrow or even in the next year time frame. So most of them are really trying to get the most out of their existing power envelopes. So Blackwell is going to be a huge uplift in terms of the productivity they can get out of their existing power assets. In terms of the long term, I think that's really where we're working very closely with grids, with data center build outs, with other partners and providers to make sure that the data center as a whole is as efficient as possible so that as you begin to ramp and build out these next gen data centers, the grid's prepared as well as the infrastructure's prepared.
And when speaking about the grid, the electrical grid, there's so much that is being invested in upgrading these grids. How do you see AI playing a role in the upgrading of the grids? Will there be a role for AI to play to make grids more efficient?
Absolutely. AI is going to be critical to enabling sort of the next wave of infrastructure. We talk about the grids as one sort of key use case, but it'll also play out in manufacturing and aeronautics and a number of heavy industries. But for the grid in particular, we're working with a number of partners. So in one case, we're working with a company called Utilidata. And they build smart meters and smart edge devices within the grid itself. And so if you kind of abstract what the grid is, it's really a bunch of components. It's transformers, it's substations, it's transmission lines. It's all of these interconnected endpoints that create this electrical system. And so what we're doing with Utilidata, we're actually embedding some of our processors in their smart meter ecosystem, and that allows for us to use AI to create a much more smarter and intelligent grid. And so what does that enable? So when you think about managing the load across all the disparate systems, most utility providers have to be very conservative in terms of how they're modeling the utilization to make sure that they don't get any hotspots. But by having that two-way communication, it allows you to have much more information to then optimize utilization across the grid. And that's another key thing that a lot of data center providers are looking to do. They're looking to bring more load, in fact, more renewable energy to the grid. So by optimizing the utilization, giving more data, more insights, it'll allow utility providers to have more certainty when they're able to bring on new workloads, especially renewable workloads.
And our thanks to Dion Harris, NVIDIA's head of data center product marketing, and also Inez Ferre for bringing us that conversation. Now coming up, we're chatting some of our trending stories of the day. Plus, we are previewing what you can expect from Meta's Connect event that is going to be this afternoon. Stick with us for more right here on Catalysts.
got 3 trending stories for you today, and it's all about AI. So let's get right to it. The first one, OpenAI pitching the White House on a massive data center build-out. The AI startup calling for data centers as large as 5 gigawatts. They would use enough energy to power nearly 3 million homes. So this is according to reports that were out following the recent meeting at the White House that was attended by Altman, the CEO of OpenAI, also other tech leaders there, and really just getting in the position here in order for wider AI adoption here, just in terms of what this ultimately means for energy usage, getting that infrastructure up to speed, just laying out what exactly is needed in terms of the investment front in order to support those types of energy needs down the line. So again, it will be interesting to see how this develops. But again, to put this in context, 5 gigawatts, roughly the equivalent of 5 nuclear reactors, or enough to power those 3 million homes that we outlined.
Yeah, it's certainly going to be a regulatory challenge moving forward just because of the degree of energy that these data centers require. And that's exactly what I was able to speak with Dion Harris over at NVIDIA about yesterday. And this is why we are also seeing some competitors in the space. I think about Microsoft utilizing nuclear energy and getting back to that. Obviously, it's a very risky form of energy, but we are seeing Microsoft working with Constellation, for example, on that 3 Mile Island plant that is potentially going to be a catalyst, I hate to say the word, for more nuclear energy moving forward. So it's something that could potentially be a way to solve for the degree of energy that these data centers require, to your point, Shauna, powering 3 million homes for 5 gigawatts.
I love to say the word catalyst.
I know.
Catalyst.
I try not to. I try not to overdo it because it's on my
Good.
mind so much because it's the best part of our day. All right. Also, the market for AI-related hardware and software could grow between 40 and 55% annually, reaching up to $990 billion by 2027. That's according to Bain. And it's really interesting. They talk about 3 areas of opportunities here: bigger models and larger data centers, no surprise, enterprise and sovereign AI initiatives, and software efficiency and capabilities, saying that the industry could reach $1 trillion in just the next 3 years. And honestly, Shauna, what I found fascinating about this is $1 trillion in 3 years. That's obviously a huge run, but it's not the largest estimate that I have heard, especially in my reporting on AI-powered technology for some of the big tech firms. Some of the folks who I've spoken with for those stories expect it to be over $1 trillion in just the next couple of years. So, but when you look at the research Bain put into this, it is fascinating to see them come up to that number.
It is. I mean, it's safe to say you're going to see a lot of growth within the sector, right? A lot of investment. We have certainly seen that, to say the least, when it comes to some of those investment plans that we've seen, not only for the larger tech names, but really across all industries. And what I thought was interesting here, laid out from Bain's chairman of the global technology practice, David Crawford, he went on to say that generative AI is the prime mover of the current wave of the change that we have been talking about. But he did go on to say that it's complicated by the post-globalization shifts and the need to adapt to business processes to deliver value. So that really leads to the ongoing investment, what is necessary in order to get to that wide-scale adoption of that technology, and the money that is needed in order to get these businesses across all industries, which of course are showing interest and already currently investing in the technology, just what exactly that is going to look like. So likely you can debate the exact number of what those investments will total here over the next several years, but certainly getting close to that $1 trillion value.
And it kind of answers the question from investors too about AI ROI. If it's going to hit $1 trillion, then it's certainly there's going to be money spent on this.
And Meta is holding off on joining the EU's voluntary AI pact before the law takes full effect. The company can still join at a later stage. Other tech giants, Microsoft and Alphabet, have already confirmed that they are going to sign the safety pledge. So where does this stand? They're holding off for now. The EU AI Pact is a temporary measure until the full implementation of the AI Act. That is effective of August 2nd, 2026. So just less than 2 years from now. Like we said, Microsoft and Google are going to participate in that pact. Meta, for right now, saying that they are not, but they do say that they remain open to future discussions, whatever that means.
Yeah, it's interesting because, and just to kind of give an overview of what these companies are signing up for here, Meta being the outlier amongst some of the hyperscalers that did not sign on, basically charting whether or not these AI tools could be used in high-risk situations and environments. We think about policing, cybersecurity, policing as well, education, as I mentioned too. We're going to get more details about the pact, but I think it's interesting to note that the pact is not legally binding, so perhaps Meta keeping their options open as well. Those that do could avoid potential clashes with the EU. We've seen them certainly cracking down on a lot of regulatory pressures on these tech companies, so perhaps Meta is taking a bit of a hands-off
Yeah, and that's a
approach.
great point, right? Because maybe that could ultimately influence or maybe persuade Meta to join the pact down the line. They're saying right now they're staying on the sidelines, but again, they're open to the ongoing discussions. Let's stick with Meta. The company's annual Connect event, it's kicking off today. It's bringing investors the latest and greatest developments in AI, in mixed reality, and wearable tech from the tech giant. Yahoo Finance senior reporter Yasmin Khorram joining us now with more on what to watch for today's event. What do we have?
Well, AI and mixed reality are really going to be the stars of the show. Let's start with the most obvious. We're going to learn a lot more about Llama, Meta's AI platform, what it looks like, what its use cases are as it competes with OpenAI and Anthropic. It's being integrated, we know, into Facebook, Instagram, WhatsApp, but we'll hear a lot more about what this next generation of it will do. The next thing on my list is Meta's budget-friendly VR headset, the Meta Quest 3S. It's reportedly going to be a mix of Quest 2 and Quest 3. Rumor is it's going to cost around $300. I'm also expecting updates to the Ray-Ban smart glasses. This product line has done surprisingly really well for Meta. And lastly, it's widely believed that Meta will be teasing its highly anticipated augmented reality glasses. These are internally called Project Orion. I've been talking to insiders at the company who've been working on these glasses for the last couple of years. They tell me it's really, really cool. But a direct quote is that these AR glasses may never see the light of day. Sources tell me the display technology is unproven and unreliable right now. On top of that, it can't work reliably at a price point that any of us could afford. I'm told that Meta's goal was to build 1,000 of these Orion glasses. They ended up making a couple hundred, around 400. Out of those 400, 5 of them are top quality and actually work, and each of those costs hundreds of thousands of dollars.
Sounds like they have more work to do.
Yeah, that's not a great hit rate, right? It seems like, and it's of course really critical for them because they did rename the company Meta. So a big challenge for them. But Yasmin, really great to get your reporting, especially in terms of you talking to insiders at the company to get that cover for us. So we really appreciate it. Thank you so much. Now coming up, Flutter raising its revenue projections through 2027. We'll speak with from the New York Stock Exchange when we come back.
Welcome back to Yahoo Finance. We are here on the floor of the New York Stock Exchange for Flutter Investor Day, the company announcing a $5 billion share repurchase program, shares surging over 8% to an all-time high. That comes after guidance came in higher than the street expected. And they think the U.S. gambling market is actually bigger than they initially thought. We're going to break it all down with Flutter CEO Peter Jackson. Peter, I want to start with the overall market for the U.S. I was pretty shocked to see you guys have that total addressable market come in at $60 billion, significantly higher than you had previously seen. What is different in the U.S. now than it was 2 years ago?
Josh, it's very nice to see you. And look, I am very excited. In fact, I've never been more excited about the opportunities that we see in front of us. We are the #1 business here in America with FanDuel, #1 in sports and #1 in iGaming. And it gives us a lot of confidence around projecting the size of the market. We are saying that, that we see this market as being, in North America, around $70 billion. I mean, interestingly, the ex-US market, so the rest of the world, will be about $300 billion. So it's around 4 times bigger than America. And of course, we're also #1 in that market as well. I think the quality of our product that we have for FanDuel, which is the best in the market, the best pricing, have the best overall value proposition, is what is enabling us to win with FanDuel in America and move away from our competition.
Have Americans embraced online gambling maybe more than you initially anticipated?
I think we've seen very strong performance for FanDuel in the US. We have got the best product, we've got the best pricing in the market, and so we've certainly got a higher market share than we anticipated. The quality of our parlay product is something that's really helped supercharge the performance of our business. And of course, the player narrative is so important, right? When I was watching the Jags game on Monday evening here in New York, it's all about the touchdowns and the players and the stats, and it leads itself to those parlay products that we've pioneered and have the leading version of in America.
And Peter, something that sticks out is the fact that you guys have been able to make more money off existing states, right? You're not necessarily off legalization. How does that balance sort of work? Is the path forward for you guys, does it depend on a Texas and a California legalizing, or does that not matter as much and it's more about building business within the states that exist?
We'll talk this afternoon about the fact that if you just take the existing states that we're in and you forecast forward what that business looks like by 2027, you've almost got a business that's generating around $2.5 billion of EBITDA by then. So the existing states, the 50% of the Americans who live in places where they can bet on sports today, that's a very valuable business. Of course, we do expect there to be further states that will legalize in time. The next 2 to 3 years, we anticipate there being a couple of percentage points of population increase. But in the long run, we do expect it to get to around 80%. And so when we think about the big 3 states, we do expect that 2 out of those 3 states will be available for consumers to bet in.
And you mentioned how big the international market is for you guys. I think that's an important thing for US investors to understand is how broad you are internationally. Tell me about the acquisitions in Brazil and Italy and what you think that's going to be able to do for your business.
M&A has been a very important part of our strategy. It's what's enabled us to be #1 here in America and #1 globally. If I look at the Italian acquisition, that was a transaction that we did to make sure that we became the #1 player in Italy. Right? We're #1 in America, we're #1 in Italy, we're #1 in the UK. We know that when we're #1 in a market, we make a disproportionate share of the economics. We capture more of that profit pool than other players do in the market. And so that's why we did that transaction in Italy. In Brazil, this is a market that's about to regulate. 200 million absolutely crazy soccer-loving people in that country. And for us, it was an opportunity to be able to take the Flutter edge, so our products, our expertise, technology, and our capital into that market, partner with a local entrepreneur who recognized that with the Flutter edge, our capabilities, it would set them up to win in the market. And so that's what we've done there.
And Peter, a quick final one for you on expansion in the US. There was recently a ruling by a federal judge that opened up the possibility of betting on politics and maybe betting on the election. Is that the kind of thing that your business would be interested in offering that kind of market in the US?
If I look at our businesses, in other countries in the world, we do take, bets on politics or, all sorts of, other events. So, we have the capability of pricing that. The Betfair exchange, which allows peer-to-peer betting, we have the US election on that, and so we can look day by day and minute by minute how the odds are tracking on that. So If those things become available to us in America, the benefits of the Flutter Edge is we can just switch all those markets and have those available immediately for our US customers.
That'll be an interesting thing to watch as we continue to follow that election. Peter Jackson, Flutter CEO, appreciate you joining us.
Thanks, Drew.
All right, Shauna, back to you over in the studio.
All right, Jay. All right, Josh, great stuff. Thanks so much for bringing us that interview down from the floor of the New York Stock Exchange. Let's talk about Target. Target was one of the first retailers to sound the alarm about retail theft and the huge drag it was on profits, or had on profits, back in 2023, leading the company to close several stores across the U.S. Our very own Brian Sozzi got the chance to speak with Target CEO Brian Cornell about this issue as part of our Lead This Way series, and he joins us now. Brian, what did we learn?
Yeah, well, thanks, Shauna. This is an issue not just solely dependent or revolving around Target. This is a company that's seen its margins under pressure in part because of retail theft. Walmart has seen it, dollar stores have seen it. But we finally got maybe what might be a breakthrough in improving trends on the theft issue. Here's what Target CEO Brian Cornell told me in Lead This Way.
Brian, I feel so much better today than I did a year ago. And I think it comes back to support at the federal level, at the state level, and at the local level. National level, great support from Homeland Security. You're seeing some actions at the state level. California to sign an important bill to really focus on curtailing retail crime. We're starting to see some progress. So it's encouraging. It's going to take several years. To be clear, we do not like locking up product. But we like running stores, and we want to keep our stores open. We want to make sure they're safe. We want to make sure if you come in and you need certain items, we've got a team member there with a key. They can unlock it and make sure you can get what you need. We've taken the steps to control the things we can control.
So the images you're seeing on the screen, we taped this with Brian inside of their Jersey City store. And I told Brian, look, I've never seen underwear and socks locked up in cases. I've seen a lot of the daily necessities like mouthwash, toothpaste, shaving necessities locked up at Target and other retailers. But to see that, which I guess are daily necessities, socks and underwear, see that locked up, I think underscores some of the challenges the retail industry has had as people on tight budgets have battled inflation the past 2-3 years after the pandemic, that they would go into these stores and they take items and they take them in large quantities. But Madison, you've been reporting on theft. Brooke DePalma is reporting on theft, and maybe we're finally starting to see a breakthrough, but this is becoming less of an issue as prices come down and efforts like Target, what body cams, I think retailers were looking at. They're working with local law enforcement, so maybe it's deterring some of this criminal activity.
And to his point about work from the federal and local level, that's really what I heard from folks at the Department of Homeland Security, that they were trying to make it a broad kind of effort from top to bottom to combat the theft that they're seeing at these stores. So really appreciate you bringing that to us, Sozzi. And you can be sure to tune in tomorrow at 10:30 a.m. Eastern to watch the full interview with Target CEO Brian Cornell, brought to us by our own Brian Sozzi. Thanks for that, Brian. Now coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, a rise in mortgage refinancing demand as rates drop is pushing mortgage applications to their highest levels in more than 2 years. We'll dig into the data with our housing reporter. And recent market volatility is pushing people to make their investments less risky. We'll dig into the who behind those decisions. Plus, the financial pitfalls of sports betting. We'll discuss why sports betting is one gamble that you may not want to take. And don't miss an all-star lineup of interviews this morning. Looking to book your holiday travel? I'll sit down with Brian Kelly, founder of The Points Guide. Plus, a look inside the luxury consumer with the CEO of Rolls-Royce Motor Cars. All that and much more during today's show. But first, let's kick things off as we always do. 90 minutes into today's trading action. Stocks right now, they are mixed, at least for the U.S. major averages. You're taking a look at some red for the Dow Jones Industrial Average right now, down by about 0.3%. We'll round that off to. And the S&P 500, you're seeing that flat, just barely to the upside by the hair of its chinny chin chin. And the Nasdaq Composite, that's holding on to gains of about 0.3%. Last week's 50 basis point rate cut is the latest sign that the Fed is targeting a soft landing and that inflationary concerns are more under control here. So how should you be positioning your portfolio in this current economic environment? Here with more, we've got Liz Miller, who is the Summit Place Financial Advisors founder and president here. Liz, great to have you on the program with us. So as you think about your own thesis for positioning now that the Fed rate cut cycle has begun, where have you started to rotate?
So the pivot, as we're all saying, is great. And it confirms that the Fed is now thinking about growth as much as inflation, or maybe more so. And that's what investors want to hear. They want to hear that, you know, the central government is supporting growth in our economy, which leads to growth in their portfolios. So far this year, we saw the early part of the year really led by, we know, the mega cap techs, and they've held up fine. But what we're going to see now, and we've even started to see in the last week or two, is that some of these other sectors that are more interest rate sensitive are going to start doing better, like housing and rentals and financials and consumer goods that really were struggling in the market the first part of this year.
You know, I can't get a few stats out of my head. One of them from Ryan Dietrich specifically, that's looking at the amount of moves that we've seen, continued moves higher after and as the Fed kind of begins their cutting cycle. And in the past, when they've begun their cutting cycle anywhere within this 1% of all-time high range, we tend to see a rally even thereafter, setting some new all-time highs of about 14%. And so with that in mind, what would you position yourself in order to see your own perhaps benefiting from some of the more outsized sectors that could stand to benefit the most in that continued run-up?
Yeah. Well, first, I do want to say that when we talk about the market at all-time highs, we're really talking about the S&P 500, and it's very skewed right now by those mega cap tech stocks. When we look at other sectors, they aren't making all-time highs. And our last high in the market was really December 2021, before 2022 was dismal. And we're constantly looking at what sectors have made new highs 2 years later, 2.5 years later. So this market has really been pretty flat under the covers for a long time. So we see plenty of upside to come. You know, one sector we like a lot is the real estate sector that certainly also has rebounded from its bottom in anticipation of rates, but is nowhere near its previous highs.
You know, it's interesting, especially as we've been having some conversations with strategists throughout the morning, the number of people that are looking internationally and seeing where there could be a little bit of pressure, and specifically within China as well. If some of the efforts to make sure that they are buoying and restoring the economy there, if they're unsuccessful, then that could have a broader impact into some of the U.S. companies. What are you monitoring there, and how are you kind of tracking that trade, especially knowing that we could see some more potential cuts to come in that region and the rate policy?
When we think about China, what we often talk about is China helps define the global pie. When China is growing, the global pie for everyone is a lot bigger. And so their slice just naturally grows. When China is struggling, they don't inflate further that global pie. We're all dealing with our own contributions to global growth. And that's where we stand today with a somewhat stalled China. Very bold moves yesterday, but I think investors are still skeptical to see, is this going to not only help the real estate sector in China, but what's really needed is to get consumers in China to regain their confidence and start spending again. We look at luxury goods as sort of one of the easy views on what's China spending. We own a lot of multinationals, from Apple to Nike, that all do better when China is doing better. So we see this in small ways in a lot of US investments too, and we're tracking that sort of company by company along with those broader policies.
You know, while we've got the swoosh up on the screen right now, I understand that Nike is one of your leading picks here. Take us into the thesis there. The company just had and is about to see the changeover at the executive level. CEO Elliott Hill going to be coming in mid-October. What's your anticipation there?
This is definitely a turnaround story in terms of the fundamentals, but Nike is one of the most valuable brands in the world, and the stock has not done well. It's been on a continuing decline over the last year plus from a nice high, and that's on a lot of missteps internally. When that's the case, then you know you can turn it around. It's a valuable brand, and a lot of runners and athletes still look for their performance goods. But they've really missed the boat in letting other companies get into that space, and focusing sort of on the collectibles shoe market has been a real distraction there. So we're looking forward to new leadership, helping them regain their position that they've long held as a sporting goods technology company. And they will get an extra boost as China improves, as you said, if that happens. But even still, there's so much upside in this company today just from improving their own internal operations.
Liz Miller, who's the Summit Place Financial Advisors founder and president. Liz, thanks so much for taking some time here with us today.
Thanks.
Certainly. So what's up must come down, right? With stocks hitting all-time highs recently, you might be feeling a little bit worried about a potential downturn, but you're not alone. According to an Allianz study, more than half of investors say that they've made changes to their portfolios to make them less risky or conservative. To break down how investors are rethinking their investments, we've got Yahoo Finance's very own Alexandra Canal. You've been looking into the details on this one, Ali.
Yeah, Brad. So even though stocks remain at record highs, there's this growing fear among investors that we could be entering a recession at some point. Whether that's 6 months down the line or 1 year remains to be seen. But we did see a surprisingly weak reading on consumer confidence. There's a lot of caution around the state of the jobs market. And all those potential risks are leading more Americans to examine their financial situation closely. According to this study, 51% of Americans say they have made changes to their investments to make them less risky or more conservative amid market volatility. Millennials in particular are most concerned, 58% making those changes compared to 46% of Gen Xers and 41% of boomers. There's also an increased focus on adding more protections to portfolios, especially with the upcoming election. Nearly 3 in 4 survey respondents worry that the upcoming election will cause more market volatility, with 49% concerned that another big market crash is on the horizon. But here's the somewhat good news here. We have seen inflation moderate, and due to that, more Americans are feeling a bit better on that front, although the majority still cite inflation as a top area of concern, with 66% of those surveyed saying they expect inflation to get worse over the next year. Not great, but that is down from 71% in the second quarter here. So bottom line, there are more concerns that's leading to people to kind of take a deep dive into their portfolio, seek professional help. The majority of those that were in this survey said they've either actively engaged with a financial advisor or they're planning to amid potential market volatility. So it's always a good idea to sort of check where you're at, especially if there are concerns, lingering concerns, overhanging concerns about where we could be heading.
All right, we'll see how that plays out for some of the larger flows in the market right now. Alexandra Canal, Ali, thanks so much. Appreciate it. Well, turning now to ways to play the market as the Fed cuts rates. Gold still hovering near its record high as weak consumer confidence data bolsters the case for bigger rate cuts this year. And bonds seeing more inflows off of the back of last week's Fed rate cuts. 35% of all ETF net asset inflows this month are into U.S. fixed income ETFs, according to VettaFi. To discuss how to play both assets, we've got Cynthia Murphy, who is the VettaFi investment strategist, as part of this week's ETF report brought to you by Invesco QQQ. So, Let's start with gold. We got to begin there. I mean, we've seen this record-touching run, and got to wonder if there's still more fuel in the tank there.
Hi, Brad. It's been an amazing year for gold. I was reading some stats yesterday, just looking at some numbers, and I think gold has made more than 30 new record highs so far this year. It keeps going up, up, up. And now that the Fed has cut rates, it's almost like the perfect storm for gold prices. Everyone you talk to on the street, every market expert, macroeconomist, everyone has a bullish case for gold at the moment. You know, the prices tend to be inverse correlated to rates. So lower rates, good for gold prices, even though the rates came in this idea that, you know, soft landing, inflation is contained. There is a concern that it could actually be to stem economic weakness. It could be to try to manage. There's a concern that inflation isn't fully over. Gold is a hedge against inflation. It's a safe haven. So all of the catalysts for gold performance seem to be in place, and the market is very bullish gold at the moment.
Is what's true for gold ETFs also the same for some other commodity ETFs, or is there kind of a bifurcation or a differing in how investors are playing these?
You know, from the metals group, gold is the best performing precious metal today. The other metals, they tend to be more industrial use, so there's a cyclicality associated with them. And when you look at commodities as a broad diversifier, commodities have been a big part of portfolios this year. Part of that diversification story, that manage your risk exposure. This time of year specifically, you tend to have a little bit of a low in the U.S. The agricultural commodities are entering harvest season, which means abundant supply, pressure on prices. So it's a tricky moment for agricultural commodities, but in general, the commodities and the metals have been great diversifiers for portfolios this year.
Can you tell us if this might be the time to play fixed income ETFs ahead of more potential rate cuts?
So fixed income has been the asset class everyone is really interested in. And it's been a shifting story. So the change in the rate policy really opened the opportunity on the duration play. So people are moving that, you know, cash-like exposure. We've seen all this money in the last couple of years go into that short end of the yield curve. It's that, you know, almost like cash type of exposure, your money market funds. They were capturing, what, 5%? You know, a lot of yield to have your money sit in a cash-like position. But now the rates are going down. Going longer duration is starting to make sense. So we're seeing money go into things like, you know, the 7 to 10 year, 20-year treasury space. We're seeing money go away from short and into that longer duration exposures. It's that lower rate makes the opportunity really interesting on the duration side of the bonds.
And so with that in mind, is it U.S. specific, or are there other international ways to play the bond market and fixed income, especially given where we're seeing some of the more the cutting cycles start to at least initiate in thought elsewhere around the world as well?
Yeah, there's an interesting resonance globally, this moment of tinkering with rates. What's been interesting to see in the ETF space is that domestically, there's a lot of exposures folks are using. A lot of folks are using aggregate type of bond portfolios like your AGs and BNDs. But on the international space, a lot of the money is going into the actively managed strategy. So, you know, Capital Group, Fidelity, different Franklin Templeton, different product providers, because there's a sense that to go internationally, the story isn't as clear cut. There's different moving parts, different countries doing different things, different central banks moving in different ways. So an active manager can really add value here, choosing which bonds to go, how far in duration, how much credit quality to play with. So active management has really stood out as an interesting play here to go international.
Really interesting. Great insights and perspective as always. Cynthia Murphy, who is the Zedify investment strategist, joining us here today on Yahoo Finance. Cynthia, great to see you.
Great to see you, Brett. Thanks.
Thanks. Turning now to the housing market. Mortgage applications hit a 2-year high last week. That's according to the Mortgage Bankers Association. To discuss what's behind the surge, we have Yahoo Finance housing reporter Danny Romero. Hey, Danny.
Brad, the surge was really driven by homeowners who are taking advantage of lower rates to refinance their existing home loans. Mortgage Bankers Association reported that applications to refinance jumped 20% last week. This is the second consecutive week of double-digit gains, and refinancing made up more than 50% of the applications last week. Now, shifting over to the new home market, new home sales dropped nearly 5% in August as more buyers are waiting for rates to fall even further. The drop in rates really reflects how elevated mortgage rates and high home prices are really impacting the appetite for new homes. Builders have been really trying to sweeten the deals to really help with affordability, but it just hasn't been enough, Brad.
And so for those in the market for a new home, there might be some keywords that they should be looking for to save some cash. Danny, can you explain exactly what buyers should be looking out for?
Buyers, if you're looking for a bargain property, there are a couple of phrases to look out for. According to Realtor.com, there's a connection between certain phrases and listing prices. If a home is listed and includes the phrase price to sell or something along the lines like undervalued, it comes with a $38,000 discount off the median home price tag. Remember, real estate varies from city to city, so markets in the South or the Midwest, they could probably have a larger discount, while in Florida and in the Western markets, it's more of a smaller discount, Brad.
All right, Yahoo Finance Zone. Danny Romero on all things housing. Thanks so much, Danny. I appreciate it. Coming up, everyone, we'll break down the biggest travel trends this fall with the Points Guy founder, Brian Kelly. Don't go anywhere. You're watching Well. As the fall season unfolds, it's time to start thinking about the upcoming holidays here, with demand for holiday travel expected to rise. Securing your flights early, folks, can save you money and stress. For more on what to expect in the coming months, we've got Brian Kelly, the Points Guy founder, the Points Guy.
The original. There's many others now.
OG. Brian, great to have you here in
Thanks
studio
for
with
having
us. So what on the demand front can we expect this holiday season? Just more crowded airports, more
it's going to be
tickets?
really busy holiday season, especially with the economy showing signs of giving consumers a little relief. Those, rates coming down. I think people are just feeling good about spending, and all the reports we've seen on consumer spending, people are shelling out for travel. They may scale back in other areas, but especially on the upscale side of the market, we're seeing huge interest in places like South Africa, safaris. I'm actually going next month, and the flight prices are extraordinary. Now, there still are deals out there, and actually airfare in 2024 is still below where it was in 2019.
Okay.
But what I encourage people to look at is the total picture, because on the economy fares, while fares are about even, there are now more fees than ever before, and baggage fees, et cetera. So the total cost of flying, but the fact of the matter is we're not seeing the crazy airfare inflation like we were in 2022 with that revenge travel. So there are deals out there.
So talk to us about timing here. Everybody always, they want to know what is the best day and the cheapest day to book flights, and is there a deadline for when to book your holiday travel?
Look, we're going to look at large numbers. Every route is different, and there might be a conference in Vegas that, if that's your hometown where you're trying to go for the holidays, that could skew things. But in general, for Thanksgiving, domestic travel, you're looking at about 45 days in advance is the sweet spot. So you still got a couple weeks left. I would say just start monitoring today. I love using Google Flights. It's free. It'll pull in most airlines, and there's actually it's called Points Path, and it's a browser extension that you can put into Google Flights. So it'll show you the price of the flights, and then how many points on that airline's program. And it'll actually give you a recommendation. Hey, you want to use your United miles? That's a really good deal, or not. So that's one of the cool new tools that's come out this past year, that it saves you a lot of time from saying, should I use my miles or not? It's all on one screen, all the different currencies.
It's so interesting because in my feed, I get some of these travel hacks, even when you're using Google Flights, for instance, like just put in a destination, don't put in a date, or don't put in, where you're flying out of, things like that. What have you found to be the top travel hack in this day and age when you're using some of these?
Flexibility is how you save money. In the green room right before this, let me see what deals are out there. It's actually cheaper. So if you want to go Thanksgiving to LA, New York to LA, it's about $500. But I wanted to see what Europe was like that weekend. So long weekend in Europe, you can put in New York City to Europe. In Google, they have an Explore tab. And it's actually $50 cheaper to fly to Copenhagen and Paris and London from New York than it is to go to LA. So, but certain cities were more expensive, Barcelona, et cetera. So you can filter by nonstop. And that's where I like to go where the deals are. And if you're flexible, you want to go to the Caribbean, you can do the same search for Caribbean, so that's really how you save money. But I will say, for the international flights, you want to book 3 months in advance. So for that year-end trip, I would say book now, because international flights really start to skyrocket as the departure date approaches.
How can travelers make their airport experience smoother this season? I mean, there's only so much booze that you're going to have before you hop on a flight. So how else can you make that experience very smooth?
Well, I mean, number one, I hate lines. I hate waiting in line. So you've got to get TSA pre-check and clear. It depends on the airport you fly out of. Not every terminal has it, but I find it to get me to the front of that TSA pre-check line. And now Clear and PreCheck have a partnership where you can get it all in one.
I saw that, yeah.
Some credit cards or some airline elite status will get you that cheaper. But it's really about the credit cards. The lounges, airline lounges are decent, but really the credit card lounges, Chase Sapphire has a bunch of new lounges that are extraordinary. Their LaGuardia lounge is really nice. You can actually get food delivered to you in the lounge, hot meals, no upcharges. Like a lot of the airline lounges, oh, you want this premium cocktail, it's $10, but whether it's the Amex Centurion, Chase Sapphire, or even Capital One has new lounges as well. Those are the best ones in my opinion, because once you get in, everything is free. So,
which travel or accommodation partner has the best card from what you found right now?
So Everything it really depends on what you spend money on, where you want to go. So we actually at the PointSky, if you go to the pointsky.com/match, we've got a questionnaire that'll match you with the best credit card for where you spend the most money on. And in addition, we link up with the credit card companies where we'll give you special offers. So before you apply for a credit card, make sure, see if you're targeted for a special offer, because sometimes the credit card companies will give you double the sign-up bonus that they're giving on their public website. So always check card match. But in general, I mean, I love the Amex Gold. It has an annual fee of $325, but immediately you get $100 if you're dining at a Resi restaurant, if you're Dunkin' Donuts, Shake Shack, there's all these credits that really can make it, and that's 4 points per dollar on dining and groceries.
Interesting.
And so I would just say to people, get a card that rewards you where you're spending the most. The Bilt credit card gives you, only card that gives you points on rent, and 3x on dining, and that has no annual fee. So I'd say of the no annual fee, Bilt really can't be beat, especially if you're a renter. Amex Gold, and for everything else, I use Capital One Venture X, because that's 2 miles per dollar on everything. So the goal is to get 2 or more miles on every single purchase. So you have that base card, and then you spend on the other cards where you're spending money.
All right, we just had the Bilt founder on not too long ago as well here. Also, just lastly, we only got about 45 seconds left. How much should travelers get compensated if their flight is oversold? The amount, the marker that they should say, I'm not budging for less than this.
You know, it really depends on when the airline can get you out. If it's 2 hours later, look, $300, $500, and it just depends too on how many other people. If there are no other people, look, it's a negotiation game. I always say be nice, you know, approach the gate agent and say, look, I'm gonna make your life easy. I'm not gonna, but you know, hey, give me $800. And if they need you, they'll do it. The gate agents don't care about the voucher to the airline. And always ask on that next flight, can you put me in first class? And if you're nice, sweet talk them a little bit, they'll give you the voucher, and what is that? The squeaky wheel gets the grease.
Yeah.
It never hurts to ask to be reaccommodated, and often they'll put you in a revenue class, you earn a ton of extra miles.
Brian, great to catch up with you. Great to have you on the program here. Brian Kelly, the PointSky founder. Thanks so much for taking the time.
Thanks for having me.
Absolutely. Guys, coming up, more than half of Americans feel like they can't meet both their immediate financial obligations while also saving for retirement. But does the perception line up with reality? That's coming up next. Are you worried that you aren't saving enough money for retirement? You might be better off than you think, actually. According to the latest data from Principal, less than half of Americans say they can meet their financial obligations today while also saving for retirement. But in reality, the numbers might tell a different story. Here to discuss, we've got Chris Littlefield, who is Principal's President of Retirement and Income Solutions. Great to have you here in studio with us, Chris.
Great. Thank you, Brad.
Absolutely. So, I mean, let's talk about this. It seems like people feel they're in worse off shape than they actually might be. Why do you think that is?
Well, I think certainly the inflation has really had a pernicious effect on the American consumer. I think people talk about the 3% headline inflation rate, but I don't think that really captures the impact that inflation has had, combined with the depletion of pandemic era savings. And so I think people are really feeling that stress. And so when you talk to people and less than half say, I don't feel like I can do both, manage my current financial situation as well as save for retirement savings, that's natural. But what we see in our survey data is that a number of working Americans are actually making a big effort to save. We've seen a big increase in deferral rates and savings rates. We've seen half of the people starting to save in our survey. We've seen another half that are increasing their rates, and about a quarter of people say that they're increasing their rates as their salary is increasing. So adopting good retirement savings habits.
When it comes to retirement savings as well, since you bring that up, and the habits that we need to put together, Principal has found that Americans' perception of their ability to save is different than the reality of the situation. So how do you kind of change the habits that are going to be effective in saving for retirement as well?
Yeah, it really, a lot of working Americans just don't know what to do. And so being able to provide advice and have somebody that you trust, a lot of the retirement plan providers are able to offer free resources at the worksite that people can go to and start talking to. And the ability to talk to somebody, a financial advisor, somebody that can help them make decisions is really impactful, because people just don't really know what to do and how do they get themselves out of this particular problem that they're in.
I want to do a little perception versus reality here. One perception that financials and one perception that Principal has found out as well to be true is the retirement savings gap between men and women. Why are we seeing women struggle to save as much as male counterparts right now?
Yes, I think it's a great point. In our Global Financial Inclusion Survey that Principal conducted, we found that women lag men across nearly every measure of financial inclusion. Women are, when you ask them the question, can you manage both your immediate financial as well as your retirement long-term savings? Less than 40% of women say that they're comfortable doing that, and over 50% of men say that they're comfortable doing that. And their retirement balances reflect that. Women's retirement balances within plans that Principal supports are 44% lower than men. And there's a lot of explanations that we're well aware of. The wage gap continues to be a challenge. Many times the caregiving role is really impacting that ability. And so there's a lot of reasons for it, and it really speaks to the need for personalized advice. If we just go with a one-set solution for all men and women throughout the workplace, people of color, women, you're not going to have a good outcome, and so it really needs to be personalized. We need to deal with those issues that are specific to women.
Yeah, good to highlight those factors as well. We got to do a lot more work to close the gaps on many of those instances. Chris, as you think about more broadly the differing in generations as well, it was really interesting. One of the stats that I was looking across that came from Principal as well, 41% of millennials think they're going to have financial freedom to live and do as they wish in retirement, yet the generation's collective wealth is up nearly $10 trillion in just 4 years, according to some Fed data here. So which generation and how are you seeing generations prepare differently for retirement?
Yeah, so I think what we're seeing in the baby boomer generation and in Gen X, we're actually seeing a change in behavior to change over a quarter of them. Nearly a third of those generations are changing their savings habits because they're changing their view on when they're going to be able to retire. And so we're seeing an increase in savings from that generation. If we look at Generation Z or the millennials, it's still in the understanding phase of retirement. So a surprising statistic that came out of the survey is that nearly 30% of Gen Z started saving because they didn't realize they were even eligible to save. And so there's this lack of understanding of what's available at the workplace. And so I think a lot of those generations that are earlier in their career just really need to work with their employer and understand the benefits that are already available to them that won't cost them anything.
Yeah, take that full match.
Yes,
why not?
absolutely.
Don't leave money on the table. Chris Littlefield, who is Principal's President of Retirement and Income Solutions. Chris, thanks so much for taking the time.
Thank you, Brad.
Absolutely. Turning now to a topic that could potentially make you financially unstable, sports betting. Sports betting is legal through retail and online sports books in 38 states and the District of Columbia. And according to Peter Jackson, the CEO of sports betting company Flutter, legalization across the U.S. will expand in the coming years. Take a listen.
The 50% of the Americans who live in places where they can bet on sports today, that's a very valuable business. Of course, we do expect there to be, further states that will legalize in time. The next 2 to 3 years, we anticipate there being a couple of percentage points of population increase. But in the long run, we do expect it to get to around 80%. And so when we think about the big 3 states, we do expect that, 2 out of those 3 states will be available for consumers to bet in.
My next guest is close to home here at Yahoo Finance and says sports betting may be one gamble that you don't want to take. Here with more, we've got Yahoo Finance senior columnist Jenna Herron. Jenna, I've got like one friend that's really good at sports betting, and then the rest of us are not so good and are truly gambling on this. So why and how are we ultimately kind of looking across the environment and seeing what these risks are with sports betting at this juncture?
Yeah, so there's been a couple of recent studies that have come out that really looked at the financial consequences of this, and I think this is really important. And the results were a little bit disconcerting, to say the least. The big takeaway from that first study is that for every dollar that you put toward sports betting, a household reduces their investment or their investing behavior by $2. Wow. And you're wondering, okay, so why is there that doubling effect? $1 wager, but it's $2 out, right? That's because we spend more when we bet on sports. We spend more on streaming services. We spend more at the bar when we're watching games with friends. And so not only are you putting that $1 towards the sports wager, but you're also spending more money out of pocket. That study also found that you overdraw on your bank accounts more. And for financially vulnerable households, they increase their credit card debt and then they make smaller credit card payments. A second study, also not good news, found that in states that legalized sports betting, so that's I think 38 states at this point, the average credit score in that state fell by 0.3%. If they legalized online sports betting, it fell by even more, 1%. Now you might say, okay, that sounds bad, but it's not huge declines, but consider that the study was looking at an entire state population, not just sports bettors. So you can bet that the credit score decline for sports bettors would be larger.
Interesting. So why can sports betting be so detrimental to us?
Yeah, so there was a third study that looked at that, and it was trying to tease out what factors make it so harmful. And what it found was the opportunity to bet, faster outcomes, and an illusion of control. So we have these sports betting apps on our phone. So we can make a wager at any time, any place, on any sport pretty much. Not only that, but we also can wager on, say, a field goal kick or some kind of play during the game. So that increases not only the opportunity for betting, but it also increases we have faster outcomes from betting. And so we know if we win or lose. And so that increases our likelihood to bet more and bet more frequently. The last, illusion of control. I don't know, did you play sports?
I did, growing up.
Okay, I played soccer.
Yeah.
So I'm sitting there and I'm watching maybe the World Cup. And I'm gonna think, I know a little bit more than somebody else because I have some expertise in soccer. Other people might be like, oh, I watch all the games, I know all the players, I read all the game reports. And so we think that we have this expertise that allows us to beat the odds, but we don't.
Yeah, exactly.
And so we have that illusion of control. So you put all this together, and what you have is an environment that's a lot more addictive and a lot more harmful for our finances.
All right, sounds like I need to recalculate the percentage of my retirement savings plans that is hinged to my betting habits as well. Jana, thanks so much for taking the time.
Thank you.
Absolutely. Guys, coming up, we're taking a peek into the health of the luxury consumer with Rolls-Royce Motors Cars CEO. That's on the other side of the break. September's consumer confidence survey fell below the 100 level as Americans voice more worries about the health of the labor market. Higher income consumers who make over $100,000 remain the most confident, but is that translating to spending? Here with some insight, we've got Chris Brownridge. He is the Rolls-Royce Motor Cars CEO, and joining us for the conversation, we've got our very own Pras Supermanian. Great to have you here in studio with us.
Great to be here.
Absolutely. We're going to get to the big news and why you're in town in a moment here, but we just mentioned the state of the consumer. What are you seeing on the super high net worth, ultra luxury spenders out there, especially as it translates through to what you see in your own company performance and build outs?
Well, what we're seeing in Rolls-Royce is a rapid increase in our clients asking for more and more bespoke motor cars. You know, our whole business is all about creating unique pieces for our clients, and the demand for more specialized commissions is increasing quite significantly.
Yeah, you know, that's why sort of you're in town for this, the opening of the private office in the meatpacking district of New York. You know, you're coming off a year where you said that you had record commissions of these bespoke types of vehicles. Why do you think that is? Why do you think this luxury consumer wants to sort of impart a kind of their own personality into their creations?
What we're seeing is a lot of our clients, when they understand what the possibilities are, it stimulates ideas for them. And that's the whole purpose of the private office, so they can spend time with our designers directly talking to them. And that's one of the unique aspects of Rolls-Royce, something I've learned. I've been with the business now for 10 months, and our clients spend time with us directly, and they get to know the business and they get to understand what they can have in their Rolls-Royce. And that makes it a real pleasure for the team at the home of Rolls-Royce in Goodwood.
As you think about the consumer, and especially the millennial generation that is going to be coming into some of those peak earnings years, perhaps looking across that cohort of consumer, that group of consumer, as you're looking to make sure that you stay in the lexicon, stay in the conversation of those decision-making and purchases as well here. What are you noticing differently about new consumers who might be engaging with the brand on generational levels?
Well, what we're seeing is an increasing demand for commissions that have an emotional resonance for the particular client. So in the past, a Rolls-Royce was perhaps a statement of wealth, and today it's more of a statement of you as an individual. So we're seeing an increase in clients asking for aspects of the motor car or the design of the car which reflect their personality. It could be the color of their children's eyes, or it could be something incorporating mother of pearl from their own collection, but it's something very personal to them. But also what we're seeing is our clients tell us the experience of engaging with a luxury house is something that really excites them, and that's something that at Rolls-Royce we're very proud of.
So Chris, you know, you're coming off of a strong 2023. How is 2024 going? We had a couple of economic headwinds here and there, but the Fed is now cutting rates. What are clients telling you about their sort of state of the global economy?
Well, we're cautiously optimistic about 2024. It's very clear that there's some volatility in the macroeconomics around the world. But at Rolls-Royce, our business is oriented around our clients. We're highly flexible, and our business is established in every corner of the world. So, of course, as one area may be more successful, another may not be, but it keeps a very balanced portfolio for us. So we're quietly confident that we'll have another successful year in 2024.
Talk about every corner of the world. What about China? What are you seeing right there now, especially as there seems to be even more of the consumer mindset that's going towards some of the local or homegrown automotive manufacturers?
Sure. Well, at Rolls-Royce, we benchmark ourselves against other houses of luxury. Our clients don't need a Rolls-Royce, they want a luxury experience. And in China, there's a growing community of ultra-high net worth individuals. But of course, everyone knows in the news there's been a lot of talk about the luxury industry in China. There are some headwinds. But for us, we're very much invested in China. We see long-term potential there. In fact, we've opened a private office in Shanghai, which is exactly the same as a private office that we have here, because increasingly clients in China, they want a motor car that reflects their personality as well. And in the first 6 months of opening the private office, we've had engagements with more than 200 clients there. So we see great potential in China in the future, and the Rolls-Royce brand has a great resonance with our ultra-high net worth community there.
Looking at the future, Spectre is here, the first EV by Rolls-Royce. Yeah. How has that reception been on the cars on sale now? You can't exactly just go and buy it, you got to commission one, but how has that response been, especially not only here, but across the world?
Well, Spectre has been a great success for us. It's a Rolls-Royce, it's a super coupe, it's a beautiful car, and everyone who's driven that car, whether it's a client or in fact a journalist, they all comment on what an incredible motor car it is. It combines technology to deliver a true Rolls-Royce experience. You've got the ease of driving, the waftability, and the absolute silence, and the great power in the drivetrain. So we've had really, really great feedback, and the car's been very successful for us, and it gives me great confidence as well. It shows that we can deliver a true Rolls-Royce, embracing different technology.
So do some customers kind of say, hey, you know what, I'm not ready for EVs yet, I want gas power? Is that a discussion that's happening?
It's a lot of our clients love their Spectre, and they see it as the best Rolls-Royce they've ever had. But of course, we still sell V12 Rolls-Royces today as well. You know, our organization is always centered around the desires of our clients. But what we know from Spectre is that when we combine a Rolls-Royce with electrification, it delivers an amazing motor car. And that fills me with confidence for the future. Yeah, we're very happy with Spectre so far.
Chris, you have your own amazing background and getting into this position at Rolls-Royce Motor Cars. I mean, take us to how you were able to get into this position and ultimately how you kind of use some of those lessons learned over other executive roles in really making sure that you're building on top of what this storied brand already has as well.
Sure. So to be asked to lead Rolls-Royce is an enormous privilege and responsibility as well, because it's a terrific brand. I've been with the BMW Group for 30 years, and I've always been absolutely fascinated by all things automotive. My real love is engineering and brand, and so I've been involved with brands like Mini and Land Rover and BMW over my career, and so I've had great experience of that. But when I got the call for this particular position, it took me almost a second to accept it, because it really is a true honor. I mean, it's a fantastic business.
Chris Brownridge, who is the Rolls-Royce Motor Cars CEO, plus we've got Yahoo Finance's own Pros Supermanian. Thank you so much for joining us in studio.
It's my pleasure. Thank you.
Absolutely. Coming up on the other side of the break, everyone, the best way to prepare for retirement might be to practice. We've got the steps that you should take financially and emotionally. Much more on wealth after the break. You're watching Yahoo Finance. Many Americans are struggling to save for retirement. According to a new Bankrate survey, 57% of working Americans feel behind on their retirement savings. 48% with a specific retirement goal don't think they'll be able to save that much. And it's not just financial strain. There are also lifestyle changes to consider when you retire. Here now, we've got Christine Benz, Morningstar's Director of Personal Finance and Retirement Planning and author of How to Retire. Great to have you here on the program with us, Christine. So, I mean, we ran through the stats there. How can people start to put in place different steps, different strategies that they can employ to make sure that they are retirement ready and have a fair figure in mind as they're moving towards that goal?
Yeah, thanks, Brad. I saw that retirement savers think they need 1.8 million to retire, and that seems like a really high number. And I wonder where people are coming up with figures like that, frankly. So as retirement approaches, as you hit the threshold of maybe age 50, start putting pen to paper about how you think your budget may change in retirement, because inevitably it will change a little bit. You may have fewer commuting costs. You may not need clothes to go into the office. So take a hard look at that. Maybe you're mulling some sort of relocation or downsizing. That'll definitely improve your budget. So look at your planned spending. Look at what Social Security will provide you if you are among the shrinking share of the population that will have a pension in retirement. Look at what your pension benefits might be, and then do some math around your retirement savings adequacy. So a very quick and dirty rule of thumb is if you can live on 4% of your portfolio initially, that's typically considered sustainable over a 25 or 30-year period, even if you encounter a really poor environment during your retirement drawdown period. So that's a starting point. Also, and I think this is super important right now, think about de-risking your investment portfolio a little bit, taking some money out of stocks, putting it into cash and bonds, not all of it certainly, because you need the long-term growth potential of stocks, but some. And the idea is that, again, if you happen to encounter a bad stock market environment, especially early on in retirement, you're building yourself a bulwark of assets that you could spend from.
Yeah.
So that's the financial side of the ledger.
Well, you touched on this for a hot second, and I want to go further into it. The lifestyle steps to take before retirement to really test things out. And you've even got the big P and the small P's within here and these purposes. I want to break those down.
Yeah, this is something that came from Jordan Grummett, who is a hospice doctor, and he's also a leading light in the FIRE movement, Financial Independence, Retire Early. So he's one of these people who retired from his main job as an MD early on, but continued doing this hospice work. And so he spent a lot of time with people at the end of their lives about what their regrets were. And he talked to me about the value of having, as you move into retirement, certainly throughout your life, you want to have what he calls big P purposes. So those might be really aspirational things that you want to achieve during your lifetime. So like climbing a mountain or writing a book or starting a foundation. So think about those, one or two things that are huge to you that you want to try. And then it's also important to have these small P purposes, which are just the things that animate us and give us joy every day. And ideally, you've got a lot of those small P purposes. So maybe it's just being a great partner to your spouse, or a wonderful parent, or, that you love to watch birds or cook or run marathons or whatever the case is. But come in with both those small P purposes and the big P purposes too.
All right. Well, as soon as Augusta National sends me an invite, I can fulfill one of those big P purchases.
All right.
Just and its purposes there. Just lastly, while we have you, we got about a minute left here. Key challenges that people tend to face when they retire.
Well, one is counterintuitive. I heard your previous guest talk about the retirement readiness crisis, and certainly a lot of people will fall short in terms of what they need. But more affluent people often struggle spending appropriately from their portfolios. They're not spending enough, and that can encompass lifetime giving. I think sometimes people underrate the value of giving to their kids when they're in their 20s and 30s versus giving them a pot of money when they're in their 50s and 60s after you pass away. It's more impactful to give those smaller gifts early on.
Christine Benz, Morningstar's Director of Personal Finance and Retirement Planning and author of How to Retire. Christine, thanks so much for taking the time today.
Brad, thank you so much.
Certainly. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You don't want to miss it. They'll count you down to and through the market close.